All right, good morning, everybody. We got about 15, 20 minutes or so before we can get started here. Some people have already done it, but if you can, as you join the class, name, email address, phone number, license number in the chat box. That's how we keep up with your attendance here for the class and make sure people get CE credit. So, again, name, email, phone number, license number in the chat box. And I'll remind you of that several times through the class, I'm sure. But appreciate everybody being here today. It should be a fun time breaking down economically what's going on and how that's going to affect our mortgage rates and therefore affect our real estate market. Like I said, looking forward to teaching the class. I'm going to mute myself here, and but like I said, we'll plan on getting started. Uh, it'll be a little bit after 10. I like to give time for people to get logged in, and there's always some, technology issues, people getting into Zoom and things like that. But like I said, looking forward to it. Get that information in the chat box for me and looking forward to being with you guys today. Good morning, everybody. We're about 5 minutes from the top of the hour here. A lot of people have already done it. Definitely appreciate that. If you haven't already, please put your name, email, license number, and phone number in the chat box. That's how we will keep record of your attendance and make sure you get the CE credit you're looking for this morning. Again, name, email, license number, phone number. And I'll remind you of that a couple times throughout the class here. We'll get started. We won't get started right at 10 o'clock. I've already gotten some emails from people having trouble logging in. So we're going to give some people time to get in and hopefully get any technology issues worked out. I hope everybody is doing well. I'll be back on here pretty quickly. And like I said, we'll get started about 5 minutes after 10 o'clock. But again, hope everybody's doing well and looking forward to being in this class with you today. All right, everybody, it's 10 o'clock. Still going to give it a few more minutes for everybody who are registered to get into the class today. Had a lot of interest in the class today, a lot of participation here. So really appreciate that. Appreciate you guys being here with me this morning. Again, if you haven't already, please in the chat box, open it up, put in your name, email, license number, phone number. Again, that's how we keep record of your attendance here today. Make sure you get that CE credit you're looking for, and hopefully you'll get some of the data and information you're looking for here moving forward, and how that looks in the market here for 2025. But again, looking forward to teaching the class today. We'll get started here in just a couple minutes. If you haven't already, log in by getting that information in the chat box for me, and we'll get started and be on our way here soon. All right, everybody, it's 5 after. Again, appreciate everybody being here. Let's see, we've got 57 people here on the meeting so far. So, like I said, had a lot of interest in the class today. Really appreciate everybody jumping on. Mention it a couple times. If you haven't already, name, email, phone number, license number in the chat box. Also, guys, we understand that, it's technology and it's not perfect. So if for some reason you get kicked out of the class, internet lags out, or your phone freaks out, or whatever, that's fine. Just jump back in for me. Again, if you do get kicked out, when you jump back in, be sure to re-sign in through that chat box for me, okay? So like I said, we want to make sure we've got record of you being here, make sure you're here long enough, and that we can get the CE credit issued at the end of all this. So appreciate it. For those of you who don't know me, I recognize a lot of familiar names, familiar faces here on the meet today. My name's Jay Alexander. I'm a loan officer, and we're going to be breaking down the inner workings. I always joke with people, by the time you're done with this class, you'll probably be a economics expert and be able to maybe run the country better than the people who are doing it right now. But no, it should be good information. We'll go through some basics, talk about how certain things work in our economy, and then how that ultimately trickles down to mortgage rates. And then obviously, mortgage rates, I think we all know, have a pretty big impact on the real estate market and what happens and what we do day to day in the real estate environment. So let's see here. I'm going to go ahead and get my slides started here and share my screen. Let's make sure that that is working like it's supposed to. There we go. All right. So in the chat box, can everybody see the interest rates, economic news, and the Federal Reserve slide? Good deal. Love when technology works. So hopefully everybody's in the right space here. We're going to be talking about exactly what you see on the screen: interest rates, economic news, the Federal Reserve, and then I'm going to give you my thoughts and projections for what data we've seen and how that will affect us moving forward. Um, Real quickly, getting into the class here. Um, Mentioned this before. My name's Jay Alexander. I'm a loan officer. Been doing this for about 18 years. Couple things about me. I love, love, love real estate. I bought my first property when I was 19. I've managed a hard money company. I do real estate investings. I've done long-term rentals, short-term rentals, flipped properties, things like that. Have a wonderful family, have a beautiful wife and three wonderful sons. And I really enjoy teaching. I enjoy doing these CE courses. I do at least one CE course a month. And we're always trying to come up with new content and kind of see what people are interested in, what questions I get from people going out in the marketplace day to day. And that's what birthed this class. Okay. So starting off my CE promise. This is kind of a joke, but I didn't put the GREC number on this one. It's something like the 80,000th GREC course that they've approved or something like that. And my joke is always that this will be better than at least half of the other CE courses you've ever sat through. So, we aim for the stars here, top 40,000. But no, I do my best with these courses, guys, to try to stay as untechnical as possible and try to keep the information geared towards what will help you ultimately sell a house. I mean, that's the whole point of this. With that said, this particular course, when we're talking about economic news and data and interest rates, it's inevitable it's going to get a little bit technical. Okay. So, again, I'm not a big fan of anything that's boring. I'm try to hit the highlights so where we can understand what we're doing here. Also, as I'm going through the course, I do make it a point to keep up with and pay attention to the chat box. So if you have questions or things, you're welcome to type that into the box, and I should catch it and be able to cover questions because I want to make sure I'm getting you the information that you want from this class. That's the whole point. Another little side note here about this class is this is my third time teaching this class. So I'm still sort of learning the cadence and the pace and still learning where some of the questions are and where some of the slides aren't perfectly clear. So again, bear with me on that, but by all means, the way I typically improve my CE classes here is by interaction, seeing what questions come up, going through and making slides more clear for the next time. I do think this will be, three times in, it'll be better than the last time or the first time I taught the course. So again, guys, looking forward to it. And, we'll get started here right now. Also, hope everybody is staying warm because, man, I was ice cold getting in the office this morning. Hopefully, everybody's got plans to stay warm and safe this weekend because I think most of us are here in Georgia where it's supposed to be a little bit dicey. But anyway, here we go. So, course outline, what we're going to be talking about today. First of all, we're going to start with just fundamentally what is a mortgage interest rate? How does it work? How do rate sheets work? Points, rebates. It's what I found in the marketplace is that the sometimes, I mean, it's a shame to say this, sometimes the average loan officer doesn't really understand what makes up their interest rate sheet or how it works. So then it's inevitable if the loan officer doesn't understand it, then the real estate agent doesn't really understand, or there's questions around it. And then trying to explain it to the customer can be somewhat problematic. So we're going to break down exactly how that works and the impact that interest rates have on the mortgage process. We're going to talk about what happens when the market moves, how we measure a market shift and a change in the interest rate market. Then we're going to talk about what actually causes those market shifts, the economic news and job reports. And we're going to cover something I call a mortgage paradox. Then we'll talk about the Federal Reserve, kind of their role, their impact, and what they do that ultimately affects monetary policy, which ultimately affects the market shift, which then in result affects our rate sheets and affects the real estate market that we exist in and try to close transactions in every day. So it all stacks up, it all builds on top of each other, but that's what we're going to be covering. And then at the end of the class, I'm going to give you my kind of best possible details, just looking into the future, kind of what we're seeing with data today, what I'm expecting to see in the future, where the wild cards are, things that can obviously change my outlooks and opinions for what's going to happen. But the goal is today for you to get a base knowledge for these outline things that we've covered. The idea is to help you stand out from the competition, to be able to speak very intelligently to people and set expectations when it comes to markets and interest rates and home prices. And are we going to have another crash? And all those types of questions that we get, instead of just having some answer, the hope is that you have an answer that's backed up by data and that you can be a little bit more confident in that answer by having a better understanding, or take the understanding you already have. Hopefully I can add to that a little bit with maybe something that I know, and then improve that, help you overcome objections with customers, and hopefully obviously that leads you to get more clients. More clients means more money in your pocket. And again, that's the whole point of this class. The hope is to help you guys go out and thrive and get an extra transaction or two or five that you otherwise maybe have lost or maybe wouldn't have gotten in the marketplace. Again, one more time, guys, as we're going through it, please ask questions. I'll be watching the chat box, and here we go. So the importance of mortgage rates. So when I was thinking about the class and thinking about how to start it, I was like, well, let's try to show something impactful, show like, why are we even talking about this? Why does it matter? And I think we all know that mortgage rates do matter. Mortgage rates impact the real estate market, but how much? Like how do we quantify that? So let me give you a quick example here. Let's say that here's a house for sale. I don't know, pick a city. It's in Atlanta or whatever. Let's say this house is for sale for $350,000. And let's say someone can finance this house at a 5% interest rate. Well, when we do the math on all that, principal and interest, taxes, insurance, PMI, I think I assumed 5% down when I read these numbers. Doesn't really matter. It gets the point across. You're looking at a total mortgage payment of $2,467. Okay. Now, if we finance that exact same house, again, same house, everything, same number of bedrooms, same house, $350,000, but that house is financed at a 7% interest rate. Well, the taxes stay the same, the insurance stays the same, the PMI, the mortgage insurance stays the same. But because of a 2-point increase in the interest rate, that total mortgage payment is now $2,908 a month instead of $2,467 a month. All right. That is a difference of $441 a month. And we can do the math on that. That's over $5,200 a year. in interest that's going to afford this house. And that's over $158,000 over the life of the loan. Okay. So obviously, interest rates matter, right? That's not an insignificant amount of money for anybody. I mean, for me or you, I'm thinking if you can go save $441 a month, you would do that. Now, the reason this impacts our real estate market so much is if you wanted to save that same $441 by lowering the sales price, does anybody have any idea from a 350 sales price, how low would you have to go in order to save $441 a month? And you can put that in the chat box for me. Any guesses? I love that answer, Regina, a lot. So lots of numbers coming in. Answer is $295,000. So you would have to lower the price of the home over $50,000 to see a $440 a month saving on the mortgage payment. Okay. So are interest rates important? Absolutely, they're important, right? Like for a customer who was for a customer who was interested in this house at $2,400 a month, $2,500 a month, for them to stay a customer for this house as interest rates go up, you're looking at the price of that house needing to come down $50,000 for them to stay a customer. Obviously, interest rates going up is going to affect the demand for real estate. It's going to shift what people are looking to buy. It shifts their price points to a lower price point. That pressures the market for homes not to increase in prices as fast. So it has a big impact. So hopefully, that's a number for you to show, yes, interest rates are important. With that said, guys, though, I think it's always important to hit this one last data point. This is a chart of the average 30-year fixed mortgage rate in the United States going back to about 1970, I think. I think I pulled the data back to like 1968 or something like that. And you can see mortgage rates have been all over the place, right? And I think everybody knows back in the mid 80s, the Jimmy Carter administration, that's when mortgage rates really got crazy out of hand. We saw 17% 30-year fixed interest rates. That's the data point that everybody likes to talk about on Facebook, where I remember the first house I bought was 19% or 12% or whatever it was. That's the time frame that we're talking about when that happened. But the point of this chart, guys, is to show you that it doesn't matter what year it was. And by the way, the gray areas, I know that's kind of hard to see. The gray areas represent recessions in the economy. Um, every single year, though, whether it's 1995 or 2000 or 2010 during the mortgage debacle, mortgage crash, whether it's 2019 before COVID, it doesn't matter. You can pick a year, you can pick any data point. There were always real estate agents in the market making money. There were always transactions happening. And real estate happens it obviously mortgage rates impact the market, but real estate happens regardless. So while interest rates are important, and we can certainly in this class give you some ammunition and show you how to overcome some objections, something I always coach and train real estate agents on is don't let interest rates be the excuse ever to not go prospect, not go market, or be the excuse to say, well, this is why business is slow. Like, I promise you, there's agents, regardless of where rates are, that are out there making money in today's market. And so, all that to say, interest rates are important, but interest rates just, at the end of the day, it's not the end all be all. It's not totally important. Make sense? So so that's just kind of my coaching or my encouragement for you. Yes, interest rates matter, but no, interest rates are not the end all be all of the market. With that said, obviously this class we're going to be laser focused on interest rates, but I just want you to know that you know it's go sell real estate regardless, and any way that I can help you do that, that's what I want to do. So moving along here. So we know interest rates matter. We know they are important. So let's talk about a few things, many, many things that impact interest rates. And this is where I like to bring in the agents that are on the call. Just throw out some stuff for me. I think if you hold down spacebar, you can actually unmute yourself. But just give me, just start listing it. Things that can affect an interest rate. What causes a customer's interest rate to be higher, lower, different? Like what in their loan file will impact their interest rate? Very good, Chair. That's the first one, right? Credit score. DTI is a good one. How about the loan amount? Interest rates are probably going to be different if the customer is borrowing $100,000 versus $500,000 versus $1 million. How much money the customer's putting down, the loan to value. If they're putting 50% down, they're probably going to get a different interest rate if they're trying to do 100% financing. Loan term, right? A 30-year mortgage is typically higher than a 15-year mortgage. What are they buying? Is it a manufactured home? Is it 2 units, 4 units? Is it a condo? Are they buying an investment property or an owner occupied property? Are they purchasing a home versus refinancing? Is the file a manual underwrite? And if you don't know what that means, you need to sit in on some of my other CE courses where we talk about it. How much money do they make? Are they getting subordinate financing? There are dozens and dozens and dozens of different factors that ultimately affect the interest rate that a customer gets quoted on one specific day on one specific property. And the reason I think we all know this, but in case you don't or just need a reminder, this is why it does absolutely no good for a customer to compare a rate they've quoted to what someone else has told them or something they've read online. Also, quite honestly, for real estate agents, it usually doesn't do a lot of good to say, oh man, so and so, I thought they were a good customer. They got quoted a whatever, a 6.5 rate, but I just closed a customer who had a 6% interest rate. What's going on? It's a fair question, but it's chances are one of or several of these different factors that you're seeing on the screen right now, plus a whole mess of other ones that I can come up with and show you, ultimately affect and impact the interest rate that a customer gets quoted. Okay. If you want more detail on it, all you have to do is Google Fannie Mae LLPA. That stands for Fannie Mae Loan Level Pricing Adjusters. And there is 6 pages of charts with different factors and different things that we look at, that will show you all the different things that impact the interest rate. And that's just the interest rate on a Fannie Mae loan. Here, I think I'm actually sharing my screen so I can do that for you live. Let's see. Does everybody see my Google Chrome browser right here? Perfect. So you can Google Fannie Mae LLPA. The first thing that pops up is the loan level pricing adjustment matrix. Oh, my bad. It's actually 9 pages. So 9 pages. Look at this credit score, how much money the customer's putting down. These are the hits to the customer's interest rates based off, you know, 5% down at a 640 score versus 20% down at a 780 score. And that's just for credit score. Then we have all these hits. Is it adjustable? Is it a condo? Is it investment? Second home, manufactured, all these different hits. And again, guys, this is public knowledge. I just Googled it. You can find it as well. There's different hits if it's a cash out refinance or a limited cash out refinance, different hits down here. We add on for cash out refinances, all kinds of crazy numbers. And this is just for one loan program, right? Like this is just for Fannie Mae. Freddie Mac has their list. FHA has their list. VA has their list. So again, so there's a ton of different factors and a ton of data that ultimately goes into figuring out what a customer's interest rate is. So all that to say, guys, if someone tells you, oh my gosh, so and so got this rate, but that guy you referred me to quoted me that rate or whatever, that should give you some pretty good ammunition, hopefully, to combat that objection, because that's a very common one that we get day in and day out, right? So when we account for everything, when we figure out the customer's income and what are they looking to buy and how much money are they putting down and what's their credit score, and we get all the data that makes up essentially a loan application, we don't get an interest rate. What we actually get is a rate sheet. Okay. So there's not, a lot of people have this concept that they can call up a mortgage company and say, "What's your rate?" And we just wake up one day and we go, "Okay, today our rate's 7," and we move along. That's not how it works at all. So we actually get a rate sheet, and this is what an actual snippet of a real life rate sheet looks like. Okay. A rate sheet accounts for various prices for all available interest rates, and the interest rates are priced as points. A point is 1% of the customer's loan amount. So on this particular rate sheet right here, I highlighted what is the closest thing to what we call a par interest rate. A par interest rate is the rate that we're quoting that has no points and no rebate back to the customer. It's just par. You don't get anything for it. You don't pay anything for it. We don't, it's very rare that you're going to have just a flat zero par rate. In this case, the 6.75, when I took this screenshot of this rate sheet at this scenario, and I put this slide together months ago. So this is not like an active live rate sheet of what we would quote today. I can show you that if you'd like later in the class, but just to show you how a rate sheet works and what it is, this is what a par interest rate looked at for this particular scenario. 6.75 was going to cost the customer 1.65 points. And then the way our system calculates it is the actual cost. So it was $235 worth of points. Okay. Now let's make sure we understand when we say points and how points works, how points work. Again, we said a point is 1% of the loan amount. So 1 point on a $300,000 loan, how much is that? What should that be? Very good. Simple enough. $3,000. Now let's do make it a little bit more complicated here. 2 points on a $200,000 loan. What does that mean? Simple enough, right? Let's do a little bit of math. $4,000. Let's make it a little bit trickier, right? What if it's 1.5 points on a $250,000 loan? And you're probably saying, "Dang, Jay, I didn't bring my calculator with me." And fair enough, we do have computers and calculators to run that for us. You can do the math on it. $2,500 would be 1 point. You cut it in half. It's 1250. 1250 plus 2,500, 3,750. Right. So that's how we calculate points. Unfortunately, this is made up numbers. In real life, it never works like that. In real life, we end up doing something like 1.782 points on a $423,137 loan amount, and it ends up being $7,540. And guys, I didn't make up 1.782 points. If you look back at that rate sheet, look at that interest rate right there for 6.25. Everybody see that? How many points does 6.25 cost on that rate sheet? 1.728, right? So, we have computers to do the math for us, but that's why I think sometimes customers get confused because points are typically explained like this. 1 point, basic numbers, it's easy to figure out. But then when we're actually quoting a loan, it's something like this. Okay. But it's still the same thing. It's amount of money that has to be paid for in closing costs by the customer to get a specific rate. Okay. Now, just to show you how this works, and this is an exercise I hope and trust and believe that every loan officer for every customer goes through this calculation in this scenario for every single loan. I hope they do. And it's certainly something that I think real estate agents should understand and have some concept of how it works. So let's do a rate comparison. And what I'm doing on this rate sheet is I'm comparing the par rate, the 6.75 rate, with a 6.125 rate. All right. And 6.125 on this rate sheet costs right at 2 points. It's 2.007. All right. So that's what we're comparing right here, 6.75 versus 6.1. And this is the math of how we figure out should or shouldn't I buy down my interest rate. All right. So at a 6.75, and I forget what loan amount I ran this on. I know it's low because the principal and interest is a low payment. But again, the math will work the same even if the loan amount is higher. So the principal and interest for this customer at 6.75 was $924, and they were paying $235 worth of points. At 6.125, the payment drops to $865 a month, but the points go up. It's almost $2,900 worth of points, or 2860 worth of cost. All right. So what we do is we figure out the difference in the monthly payment. It's $58.40. And we figure out the difference in the points, which is $2,625. Then it's just a simple math calculation. We do the 26 extra $100 that it cost us divided by the $58 a month in savings. And we figure out that the break-even time frame for this buy down is 45 months, or 45 months divided by 12. That's going to be what, a little bit under 4 years, 3 years and some change, 3 years and a few months. So this is the conversation that we have, with the customer on every single transaction. And that's why there's two data points that really matter when we're trying to figure out, should a customer buy their rate down. The first one is, hey, Mr. Customer, tell me about this house. How do you see yourself living here? How long do you think you'll be there? And there's different answers to that question, right? Some customers will say, well, you know what, this is really a starter home for us, but we wanted to get into the real estate market. And in perfect world, we'd love to either sell it and buy a bigger house when we have another kid or two in the next few years, or maybe we want to hold on to the house and rent it out and buy another house. That can change the math a little bit. We also have some customers that'll say, this house is perfect. We love it. It's my dream home. I plan on being here for the next 20 years, right? Well, depending on how that question's answered, I'm going to advise the customer differently on their rate buy downs. Okay. So, but this is how rate buy downs work. This is how points work. This is how it works anytime you have a client walking into a subdivision and they've got a sign out there that says, buy our standing inventory at 5.99% or 4 point or whatever it is. They're doing some type of rate buy down. There's points, there's something built in to get to those interest rates. Okay. But like I said, this is how it works. It's how it works on a rate sheet. A side note, just to show you this though, to get the same savings with a price decrease, because what we were saving in this case, it wasn't like my original example where we're saving $440 a month. We're just saving $58 a month. Again, how much do you think we'd have to drop the price of a home in order to save $58 a month? Lots of guesses, and I'm going to give you a rule of thumb. So the answer here is about $9,500. So in exchange, so I want you to think about what this means, okay? In exchange for the customer buying down their rate about $2,500, $2,600 worth, they've saved enough on their mortgage payment that's equivalent to getting almost $10,000 off the price of the home. Okay. A good rule of thumb is for every $1,000 that the home goes down in price, it saves the customer about $6 a month. Okay. So that's why, again, we're saving almost $60 a month with this rate buy down. You'd have to reduce the home, about $10,000, right? About $6 per thousand. Because of this, and you've probably seen posts like this on Facebook, and they're good posts and it's good reminders. The customer, it is always more efficient for the customer to buy down their interest rate to get monthly savings instead of the customer trying to negotiate for a better sales price. Okay. So something I'm telling real estate agents when I meet with them now, we're doing whatever, lunch or coffee appointments or just talking over Zoom or whatever it is I'm telling agents, and this has worked really well because this is what I tell customers as well. I kind of tell them that, like, look, you, to a certain extent, you control the interest rate that the customer gets. And here's what I mean by that. When a customer is looking at a home and they find a home they like, and let's say the home's priced at $400,000, and the customer comes to you and says, okay, hey, I like this home, but I want to offer $380,000. Instead of offering 380, get with me, get with the loan officer. Let's run numbers for the customer at what 400,000 with $20,000 towards closing costs looks like, and looks like their mortgage payment, versus running it at 380. Okay. And I can tell you every single time it's going to look much better at 400 with 20 grand in closing to buy the rate down. And the other thing that will do is that allows us to flash in front of the customer instead of a market rate of whatever it is, 6.8 or 7.1 or wherever, we're at in a scenario today for a customer. It allows us to flash a rate that starts with a 5 in some cases. And then you can even get into the complexities of doing temporary buy downs where the rate is artificially low for the first 12 months or 24 months or something like that. And we can flash rates in front of a customer that starts with 4 or 3. And again, that's what your subdivisions and builders already know. That's what, because we're preferred lenders for lots of different builders here in the area. And these are the conversations we're having with their sales managers. But again, I think phrasing this conversation instead of me telling the customer, hey, if we can get some closing costs, then maybe we can do something with that interest rate. I'm turning that conversation to more of like an empowering conversation. Hey, Mr. Customer, you control the interest rate on your home. It has everything to do with how we negotiate this transaction and trying to, build the file and make the financing work for the customer as well as the house working for the customer. Okay. So anyway, that's my spiel for you about that. But one thing to notice about this rate comparison, this rate sheet, everything we've been through, all that fun stuff, is that this is one example. All right. This is one point in time. It happens on every loan. Okay. And it changes every single day. Anytime there's any change in the market at all, we get a totally new set of data. So that rate chart that I showed you, the rate sheet, the way the interest rates are priced on that rate sheet, those points go up or down a little bit. They change every single day. All right. So when we talk about the market changing and how that happens and how it all works, okay? So what happens is the market actually sets the price of a mortgage. The market determines what mortgage rates we're quoting day in and day out. It's based off supply and demand, and it literally changes every second. Think of it like a market. So most people know that the stock market is either up or down. I mean, you can hop on what finance, yahoo.finance or whatever right now. And the as we, as you hop on that, you can see at any given moment, the stock market might be up 100 points, it might be up 2 points, it might be down 5 points, it might be down 100 points, but it literally is fluctuating and changing every day. Let's see, guys, I missed a question. Sorry about that. I need some more basic understanding. When we buy down points, does the length of the loan term increases? No, good question. So no, when you buy down points, when we're comparing points, and let me go back to that, guys. I apologize. I just missed that question here. So if we're doing a fair comparison here, in this example, we're comparing 6.75 to 6.125, we're comparing the exact same loan product. Okay. So in this case, I'm pretty sure when I ran these numbers, it was for a 30-year fixed rate mortgage. Okay. So whether the customer elects to go at the 6.75 rate or the 6.125 rate, they're still going to be closing a 30-year loan. It's still going to be a loan that will pay off. The term of the loan is 30 years. So buying down points does not affect the loan term. It's not going to cause them to pay the loan off sooner. I think maybe what you're referring to, and this is a real common thing people talk about as well, is the idea of making extra payments. So customers paying more than the minimum payment, in this case of either the 924 or 865 a month. And by paying more money than the minimum payment on your mortgage, you will pay the mortgage off sooner and can turn that mortgage into a shorter term mortgage. but that's, the idea of making extra payments is not kind of part of this analysis, if that makes sense. So we're just talking about how we actually close the loan for the customer. Um,
Can I
and
ask? Sorry.
specifically in purchase transactions, I think we know that we can negotiate for the seller to pay closing costs. So as we're negotiating for the seller to pay those closing costs, we can use that to, affect and improve the financing that the customer gets. Hopefully
Can
that
you
answers your
hear
question.
me?
Let me know if not, and we'll talk
Can you
about
hear me? Can you
it.
hear me?
Let's see. What are
Can you
some of the
hear me?
principles with rate movement that don't change, even though the actual numerical values fluctuate? What are some of the principles with rate movement? Okay, so yeah, good question, Scott. So we're going to talk about the principles of kind of what's behind a market movement and how that works. Okay, so good question. We'll get into that. So when we're talking about market movement and how it works, again, we've established that it's like the market. There's lots of ways to represent the data. So Scott, let me kind of explain how it works and how we measure how much the rates move, and then we'll talk about some of the fundamental principles that cause the market to move one way or another and kind of how that happens. Okay, so um, the most common way that traders look at markets, whether it's bond markets, stock markets, whatever it is we use candlestick charts. And so, guys, just bear with me. We've got to get through some of this technical stuff here to understand what's happening and how it works. You have two types of candles on a candlestick chart. You have a green candle or a red candle. Green candles mean prices went up or the market improved. Green candle means that the market started at the bottom of the candle or the bottom of the green area here. I'm drawing this on my screen like you guys can see it, but you can't. So I apologize. Um, so it starts at the bottom, the price fluctuates throughout the day, and then it closes higher than it started, and that causes a green candle. If the market closes lower than it started, you get a red candle. Do you see that? How the market opened at the top of the red candle. It can move around. The wicks show you how far the market moved one way or another in a specific day, and the bottom of the candle is how it closed. All that to say, guys, this is what an actual candlestick chart looks like in the market. So here you can see if we start, if you look at the bottom of this chart right here, let's start around what, like February 26th. We had several good days in a row. So green is good. Green is going to lend towards interest rates actually improving. I know that's a little bit kind of hard to visualize because you're looking at this and you're like, wait a minute, those candlesticks are going up the chart. If things are going up, does that mean interest rates go up? No, it's actually converse. As the candlesticks move up in the bond market, interest rates are actually going down. Okay. So green is good, red is bad. And this is just different ways to represent. And the whole point of this chart, guys, is to show you that even like, I mean, so you've got right here in the dead middle of this chart, what it's probably around February 7th or so, that big, giant, huge red candle right there. That is a huge market movement in one day. I mean, we're looking at, I mean, that was almost 100 basis points of market movement in one day, where the market was just all over the place, really, really volatile. That was a real tricky day to quote a customer an interest rate because depending on the time of day where you quoted it, rates either look to be up a whole lot and looking really good, or they ended up looking by the end of the day really, really bad because we ultimately ended up with a really bad red candle for that day. Um, so all that to say that there's a lot going on, and it's really hard to show past data because it would be ridiculous if we said, okay, at 10 o'clock this is where mortgage bonds were, and then 10:01 this is where they were, and at 10:02 it's too much to try to break it all down. But that's what this chart is trying to do. Make sense? It's trying to show you where the market opened, where the market closed on the given day, and then the range or how high it was or how low it was also on that given day. So anyway, but the point is to say that it shifts and moves, that there's always something going on. And when the market changes, what is actually happening? Okay, so when we see a shift in the market, what does that mean to our customer, or what does that mean for their mortgage? Well, what actually changes is their rate sheet, right? So these numbers here, the numbers that I ran the analysis for, the 1.65 points versus the 2 points, all that math that we just did for that customer, that math is literally no good the next day that I speak to the customer. Now, hopefully the market's not crazy. Hopefully it's not too volatile. But if rates went up, then what that means is the points that it costs to get 6.75 have increased a little bit. And more than likely, the points that it costs to get 6.125 have increased a little bit. When we say rates have gone down, that's where a lot of times customers get frustrated because they'll hear in the news, or they'll see a Facebook post like, hey, we had whatever, a good report or something happened and interest rates have improved. Well, they call back and they still get quoted the 6.75 rate. The difference is now 6.75 might be at no points, or they might get a rebate back. They might get a couple $100 that can go towards their closing costs, right? So when we say rates improve, what we actually mean is the amount of points that you have to pay for that rate have gone down. Does that make sense? So that's what's happening as the market changes. The rate is always available. That's why the rate sheet goes from 8% all the way down the sheet to 4%. It's just the price that the customer pays to get those individual rates literally fluctuates and changes every single day, right? So that is how interest rates work. That is the job of the loan officer, in my opinion, to very quickly and succinctly explain that to a customer so where we can make sure we are advising them accordingly and leading them towards the best mortgage loan for them. I always tell people there's never such thing as a best mortgage loan because it depends on the scenario. The best loan is the result of getting data points from the customer to determine what's going to be the best fit for them individually. Mauricio, why can you not always quote a loan at zero cost? It's because of the rate sheet. It's because rate sheets are priced out to the hundredth of a point, and it's very rare that you're going to get a customer or have a day where a customer has a rate that is literally no points. We just get as close to no points as possible. Does that make sense? And I mean, we can always go up the rate sheet and quote maybe 6.875 and tell the customer it's no points. And that's true. But in this scenario, that would actually it's actually better than no points. It would actually have a little bit of a lender credit built in for them at the 6.875. So it just has to do with what the market gives us on a given day. Anyway, so moving along here. So what causes the market to change? And Scott, this is where we're going to get into the principles and how the market moves and what happens. Okay. So what you have to understand when it comes to mortgages, mortgages are a financial instrument that investors throughout the US and really throughout the world invest in. Okay. And it's investors ultimately that determine the demand for mortgages or stocks or corporate bonds or government bonds or any subsection of any financial instrument you've ever heard of. Ultimately, it's the investor that's either buying or not buying that instrument that determines what happens to the price of that instrument. Okay. So investors decide, do I want more mortgages? Do I want less mortgages on my book? Do I want more stocks on my book? Do I want more bonds on my book? Whatever it is. So investors determine the demand, and then they adjust demand for mortgages based off what their goals are. And like anything, investors, anybody that's looking to make money, they're looking to invest based off what it's giving them the best bang for their buck. Where are they going to get the best returns at the correct amount of risk that they're looking for their portfolio on that given day? And again, I think everybody knows the stock market opens up for business every day, and then they ring the bell and it closes for business. But these movements and shifts are happening every single day in the market. So if we think about it, what's happening? Well, investors are trying to make the most money possible. And typically, stocks offer the best return. If you invest into a company and that company has good earnings reports and that company has they're expanding and they're hiring more people to they Apple came out with the iPhone and it took off and became a viral piece of technology that everybody has to have, and they're building more of them and they build them cheaper and they sell them for more money. Well, if you invested in Apple stock, years and years ago, you've probably made a good return. Problem with stocks is they can be very risky because businesses can make poor decisions. They can go bankrupt. That stock can go from valuable to zero in a fairly short period of time. Hopefully they don't, but it can happen. So stocks typically offer the best returns, but those returns come with the higher risk. Okay. Investors mitigate risk by investing in bonds. Bonds offer lower returns, but bonds also typically give what we call guaranteed returns. So it's a fixed rate guaranteed return. When an investor invest in a 5% Fannie Mae bond or a 6% corporate bond, what Fannie Mae or what that creditor is saying is we are going to pay you this 6% return no matter what. So they have a guaranteed fixed rate of return. It's low risk, but it also has a lower return than what they typically get with stocks. So the question that investors are always asking is they're trying to figure out how much money of the money that they manage, how much of that money do I want to have in stocks versus how much money I want to have in bonds. That at the end of the day, it's more complicated than that because, like I said, there's different hierarchies. They can invest in mortgage bonds, government bonds, corporate bonds. They can invest in high cap, mid cap, low cap stocks. They can invest in emerging market stocks. They can invest in stock markets in other countries instead of just the US stock market. So obviously, we're simplifying this a lot, but at the end of the day, investors are trying to figure out, can I get more money at a variable rate return and do better in stocks? Or do I do better to mitigate my risk and get a fixed rate return from bonds? Okay. So that is the question that investors are asking every single day. Now, how do investors determine how to invest their money? What causes them to shift or place bets one way or the other? Well, it's economic news. So they are literally looking at what's happening in the economy, right? And then they figure out from the news that they have and the data they have where to place their bets in the stock market, bond market with the portfolio that they manage. Okay. So there's really two types of economic news. There's good news and there's bad news, right? So if the news is good, what would be good for the economy? Let's think about that. Good news is typically, are we creating more jobs? Are wages going up? Is the economy growing? Are people spending more money? If that is happening, investors tend to move money to stocks. They're looking to capitalize on a growing economy. They're hoping for big returns, and they're looking to increase their portfolio and make money, right? So what happens when we have good economic news is that investors move money from bonds to stocks in order to make more money. Well, the mortgage market is backed by bonds. We sell mortgage bonds, and mortgage bonds are what fund our mortgages that we close day in and day out. If you think about it, it makes sense that the mortgage market is funded in the bond market because we said bonds offer fixed rate returns. And it's pretty easy to quote an investor a fixed rate return when we're closing fixed rate mortgages, right? A customer who closes a loan at 7%, they're kind of locked into paying 7% interest. That's backed up typically with a bond that an investor invests in that's also offering a fixed rate return. Typically, that bond's lower because there's people in between that have to make money and servicers and things like that. But in general, when investors are moving money to stocks and we have good economic news and the economy is growing, well, then what we have to do on the mortgage side is we have to raise our interest rate to encourage investors to go back and put some more money in our bonds So where we can still fund loans and close loans for you guys so we can all eat and have a real estate market. Does that make sense? So good economic news tends typically, and again, this is a very, you know, basic outlook, and there's a lot of variables that go into it. But generally speaking, good economic news tends investors to shift their investments from bonds more towards stocks. That causes interest rates to go up because we have to offer higher interest rates or a higher incentive for those investors to still invest in our bonds. And again, we need that money so um, where we can fund our mortgages. I mean, the problem with offering a 3% interest rate right now, I assure you, every mortgage company would love to do it. The problem is if we don't have an investor on the back end that's going to buy that mortgage, then there's no money for it, and then there's no market for it. So lo and behold, there's no market for it. That's why you don't have 3 or 4% mortgages in the marketplace right now. The investors are demanding the interest rates that we have to sell in order to have the money to actually fund the loan. Okay. So that's not what is taking place. That is what is always taking place. And Carol, you are super, super sweet. I appreciate that. It's always nice to get some feedback when I'm sitting here talking to my machine and don't see anybody's face. I'm used to teaching these classes live. So I appreciate that. So thanks, guys. I appreciate the kind words. All right. So like I said, good economic news, money typically flows out of bonds into stocks that causes rates to go up to encourage things coming back to our mortgage market. Well, the flip side of good economic news is bad economic news, right? Is the economic news bad? Are there mass layoffs? Is there high unemployment? Is there high inflation? And we'll talk more about inflation specifically later on. Are people saving more? That sounds converse, but if you think about it, um, if people are saving more money, that means they're not spending money, and spending money is typically what causes the economy to grow. So investors will look at savings rates and adjust bets accordingly because, and typically when people are saving more money, they're concerned about their economic outlook. They're either concerned about losing a job or concerned that stuff's getting more expensive. Savings rates actually tend towards bad economic news. When that happens, investors move money out of stocks because they're looking for safety. They're hoping to avoid losses, right? Because you don't want to be invested in Apple if everybody's concerned about what's going on and not everybody's running out to buy the new iPhone, whatever we're on right now, 16. They're looking to paying back and you're like, you know what, my iPhone 12 works great. I'm just going to hold on to this one for another year or two or three, right? Well, that leads to Apple stock going down. No investor likes to lose money. They would rather have sold when it was up, when people were buying a bunch of iPhones. You get the idea. Well, what does that do in the overall economy? Well, investors move money out of stocks to bonds. They're looking for that safety. Well, when that happens, if we already have good demand for our mortgage bonds, we don't have to offer these investors 6 or 6.5 or 7% returns on their bonds that they're investing in us. We've got more buyers than we have. So now we can buy, well, how does 5% sound? How does 4.5% sound? Make sense? So that's how it works. When we get bad economic news, that typically leads money flowing out of stocks into bonds. When the money flows out of stocks into bonds and we have more demand for our bonds, we don't have to offer big money for it. In fact, we can provide the investors with more and more bonds for them to buy the lower the rate is, right? Because we all know it's easier to sell a home when rates are lower, and it's easier for the mortgage company to close loans when the rates are lower. And they're like, hey, I need to buy more of these bonds I'm getting out of these stocks. And we're like, great, you have to take 4 or 3.5, and we can keep up with the demand that you have from us, Mr. Investor, right? So, so in general, that is how it works. What's crazy about it, and I call this the mortgage paradox, is that we hope for bad news economically, job losses, high unemployment, things like that. We just don't want it to be our borrower who we're actually trying to close a loan for, right? So it's a real interesting spot to be in because, for example, and again, we're going to get into more details with this later on in the class. Um, but it's a real interesting spot to be in because you want to have bad economic news for interest rates to improve typically, but we all know that if the economy just goes totally to nothing and no one has a job, then you're not going to be closing any loans anyway, right? So it's a really interesting scenario. In a perfect world, what you want is you want an economy where there's good demand for real estate. The real estate market's firing on all cylinders, and everybody has loans to close, everybody has transactions to close, but not at the expense of crazy inflation and things running out of control like we saw happen in 2022. um, like I said, it's just really interesting. But in general, bad news trends towards or portends to better interest rates, and good news trends towards higher interest rates. But if you think about it, it's the economy doing what it does, and it's capitalism doing what it does, which is essentially that as you get bad news and people lose jobs and things are going, negative from an economic standpoint, well, rates get lower. When rates get lower, that leads to more demand. More demand leads to more people working, and now the economy improves. So um, it's like a self-correcting system or a self-correcting market. So what happens is in a poor economy, you get bad data. So, if people aren't working and aren't making as much money and having trouble paying bills, then we see that in the data. Bad data leads to investors moving money out of stocks into bonds. They move money out of stocks into bonds. We get lower rates. Lower rates leads more people to buying houses. More people increase demand for houses. You see more houses getting built. Well, guess what? That person who lost their job, now they can go get a job building a house. And this is very, again, guys, I get that this is very elementary with how we're explaining it, but in a very broad scale, this is exactly how our economy works. Poor economy, bad data leads to lower rates, which leads to more economic activity, and now we have a stronger economy. Make sense? So that's how the market cycle works. That's how things ebb and flow, and it's specifically how it works within the view of mortgage rates and the real estate market, and how all this happens. Okay. So I know I've seen some chat stuff come through before we move along here. Let's see what we've got. Let's see. Thank you, Susan. I really appreciate that. All right. So you're saying that the stock market percentage and the bond market percentage are not both high at the same time. So Jay, so again, this is uh this is very fundamental what we're talking about here. And in general, the assumption that I'm making, which is not, and as you'll see as we go through the course, it's not always true, but for this example and explaining how this works, the assumption that I'm making as is that the two competing financial instruments, or kind of the two instruments that are fighting each other, are stocks and bonds. Now that does happen, and that's pretty normal. Um, what actually happens though is we made the assumption, if you remember from the slides before, that stocks are considered risky and bonds are considered safe. And the truth is that's not always the case. There are times where bonds are also considered very risky, and that specifically has to do with inflation, and we'll talk more of that about that in the future. But no, you can't extrapolate from this example to say, oh, well, stocks can't be improving and bonds improving at the same time. I can give you data point after data point where that happens, okay? Where stocks both go up and mortgage rates improve. So it's not one to one. It's not the end all be all. But what is the truth, or getting back to Scott's question a little bit before, kind of the fundamental principles for market movement, the fundamental principle for anything in the market is supply and demand. And that's like a joke back at my high school economics class was if you get a parrot and you train him to say supply and demand, you have an economist, right? And so figuring out how we measure that and what is supply and what is demand and what ultimately leads to things being at a specific price, that's where the economic field really excels and comes into play. But um, but no, that's a very long-winded answer to your question. But no, it's not one for one. It's not exactly how it works. But like I said, it is in general, um, whatever factors lead to supply and demand for mortgage bonds ultimately affects the mortgage rate that I quote on my rate sheet on a given day. Right? Hopefully that makes sense. Let's see. Late 80s, early 90s, there seemed to be a hot real estate market and a strong economy. Why was real estate hot during this period? Scott, good question. Again, in general, I would say that when the economy is faltering, it historically, I can give you data points where it is real estate that tends to pull the economy out of a recession. It can be other, sectors of the economy as well, but real estate is always pretty resilient in recessions. And I've got a chart I can show you that proves that. In general, home prices, believe it or not, home prices tend to go up during recessions instead of down. And the reason for that is when a recession is evident or when people realize we're in a recession, interest rates are the first thing that go down in that economy. And interest rates have such an impact on the overall price of real estate, right? Um, Now, with that said, that doesn't mean you can't have a strong economy and a strong real estate market at the same time. You absolutely can. In fact, now it was built on a little bit of not a little bit, a very sandy foundation or on a little bit of a mess. But the most recent data point for that would be what led to the housing crash in 2000, 8, 9, 10, depending on which year you want to call it. But prior to that, you had a strong economy and you had really strong real estate. That was the real estate market, though, was being artificially propped up by cheap money, by bad mortgages, right? Like that's what was happening. But still, you had data point after data point where the economy's good, real estate's good, the economy's good, real estate's good. So just because the economy's good doesn't mean real estate is necessarily bad. But in general, when the economy gets bad, because rates tend to go down, that causes the real estate market to get stimulated typically before other markets or other sectors in the economy, in my opinion. Good deal. Hi guys, so we've been going at this about an hour, and I normally like to wait to take the break to about the halfway point, but somebody has turned the heat on here at my office, and I'm sitting here absolutely sweating. So we're going to go ahead and take a quick break, and I'm going to cut this heat off and refill my water bottle here. Y'all just pause for me here, and we'll get started back here in just a few minutes. What we got? I think we'll probably break this class up into two breaks. So let's do this one. We'll give it right at about 10 minutes. Okay. So 11, 19, 11, 20, we'll get back started and we'll go grab some water. All right, guys, I went ahead and launched that poll. Hopefully, if you're enjoying the class, you can fill it out for me. If not, you want to leave it alone, I'll be fine with that as well. But no, we're always looking for feedback. And then also, before we get, fully started back here, you've heard me say it a million times, back in the chat box, name, email, phone number, license number, just a way to sign back in here from the break. I appreciate you guys being patient with me because we're sitting here talking and I'm like, okay, what's going on? Like, why am I getting mad about life and everything right now? It's like, oh, because I'm sweating and I'm thirsty and the heat's on 80 and who did that? I mean, I know it's cold outside, but good grief. But we got it under control now and back to enjoying teaching the class instead of being mad about it. So hopefully we'll be good for the rest of the course here. All right. So let me get set back up here after launching the poll. Looks like we're chat boxing. That's working. Looks good. Thanks, Carolyn. I appreciate it. Yeah, no, it was just I was like, I don't know. I'm just starting to get a little bit hot under the collar, I guess, so to speak, a little bit flustered. I was like, man, I'm sweating here. All right, let's get these slides caught back up. So we talked about the mortgage paradox, talked about how it works. Um, Good question. Yeah, so I meant to put that, and actually, after everybody kind of signs back in and the chat box slows down, I'm gonna throw a link on the screen for you. Um, I will, assuming, we get the right email address and everybody types it in enough, we're surely we'll get it right. I will email these slides out to you. Actually, what I'll do is I'll email you a link to my keep these slides on Dropbox, so you'll have access to that link where I keep the slides. And the beauty of that is, as I teach this course, because I'm always going through and updating some of the information and some of the data on here, you'll have access to those newer slides. Make sense? So yes, you'll have a copy of it, and it's okay, Justin. If you miss the poll, it's not a big deal. It happens. We get it. Um, but yes, you will have these slides, and you can refer back to them and open them up, and you can always call me when you have specific questions for anything. Happy to I if you haven't figured it out by now, guys, I'm a little bit, maybe a lot of bit of an economics nerd, and I actually really kind of enjoy this part of the job. And really, it's just about advising people and trying to, you know, make everything work. Carolyn, absolutely. Yeah, I'm a loan officer. That's what I do. I've got a team here with about 4 people, and we're ready and waiting to pre-qualify any and all of your customers. How about that? So, yes, ma'am. So we're licensed in Georgia and every state that touches Georgia, along with some other ones out there. And generally speaking, if you've got a client, in say Utah for whatever reason, we can usually get licensed really, really quickly. But yeah, Georgia, Florida, Alabama, Tennessee, Kentucky, North Carolina, South Carolina. Um, that's kind of our footprint where we certainly, I mean, the majority of our loans are in Georgia, but all around we do business all over. Appreciate it, Tyler. I'll cash app you some money here by the end of the course. All right. No, appreciate it very much. Um, so real quick, guys, the link, let me make sure I'm sending it to everyone. The link I'll give you is actually I'll show it to you, then I'll put a link here in the so if you go to Linktree/Xander team, look, there's me. Um, so I'm gonna put that link here in the chat box where you can pull it up as well. This is where you can get everything. So, you can download my contact information here and get everything that you need. This is where customers can go and apply online. Obviously, we make that a big deal because we don't want the customers to miss that. I also have, so I teach this class on economic news. Down at the bottom, there's information here we're going to go over, but I can just show you these links right now. Um, so you have access to some links here that'll be helpful. And again, we'll go through it as we go through the course. I also teach classes on and do short-term rentals. Remember, I told you earlier I did investing and things like that. And this is where you can actually see I own properties in Gulf Shores and Orange Beach, as well as I have a short-term rental in Carrollton and one in Kentucky. And this is the website where, shameless plug here, if you want to go um, stay in Orange Beach for a night or try to beat some of the cold weather that's blowing in, you can book this condo. But we do this, and then I teach classes to show people how to buy them and how to market them and make money. And that's, like I said, way beyond the scope of this class. I think right here you can also get to my Airbnb profile. And you can actually see the listings. See everything down here on Airbnb that we've got available. And anyway, like I said, shameless plug. Yeah, be on the lookout for uh, if you got to this class, you probably got through it through Dana Sparks' email with Real Estate Academy. Also, I know some people saw my Facebook post. I'll be sure to try to get that on Facebook a little bit sooner the next time I teach the short-term rental course, but that's a fun one. And this is Susan, just to continue here with the shameless plug. This is the house in Kentucky. It's actually in Lawrenceburg, Kentucky. The draw up there is Bourbon and the Bourbon Trail. And it's great. I mean, just a great little opportunity right now for investors, but it's a great little place to visit. Lawrenceburg is where, if you're into bourbon, it's where Wild Turkey and Four Roses, those two distilleries are. And then you're in driving distance to hundreds of distilleries. And they've really done a good job of, building that up and the just learning about that process and tastings and the history behind it and all that kind of stuff. It's really cool. But yeah. Oh, Eventbrite, perfect. Yeah, we get some of that. And I had some in the last short-term rental class that I taught people who just saw the course description like, hey, that looks interesting. Um, but anyway, yeah, I teach a whole class, show you how to manage it, how to market it. I self-manage all of our properties, and we do it without it taking a whole bunch of time or effort. It works really, really well. And like I said, if you're looking to invest in real estate, I've done a lot of real estate investing. Personally, for me, short-term rentals right now is where it's at. So highly recommend it. All right. So back here to the link, we'll pull that up here in a minute. But like I said, guys, you can grab my contact information here at the top, and I'll put it in the chat box as well. But this is hopefully you keep this link saved and on speed dial and in your phone. And of course, we'd love to do business with every single person here on the meeting. So anyway, we'll leave that down. We'll pull that up here in a bit. All right, so moving along, guys, we're talking now about, so we've talked about, economic news. Is it good? Is it good? Is it bad? Well, now let's talk about, well, what specifically moves the needle, or what are the big economic reports out there? And I keep up with lots and lots of different news and economic reports, and always looking for, things that we can get. On my Linktree list of links here down at the bottom, the very last link, calendar of upcoming economic news. If you click on that, this shows you, so today's Wednesday, January 8th, right? This shows you all of the economic news that they feel like, and this is a pretty good website, Forex Factory, that they feel like is a big deal or is impactful in the overall financial market. And guys, this is the world market, okay? So you can see here, they've got data reports that are coming out in Europe, obviously for mortgage rates, I'm more interested in these, the United States reports that are coming back. And the big one today, they even color code it. Hopefully, you're not colorblind, but these red folders are considered more impactful reports than the orange folder, which is more impactful than a yellow folder. Get that? So the red reports are kind of a big deal, but the ones that I'm going to talk to you about today are like the double reds or triple reds, like the big reports that really matter and can be really impactful for stocks and specifically for mortgage rates. Okay. But this is the website. Like I said, this is just one day, and then you can see tomorrow, this is the economic news. And then Friday, the huge one on Friday is these right here. We get a jobs report on Friday. This class was like perfect timing. I wish it would have been after that jobs report came out because we would have broke it down and dissected it. We're going to dissect the previous jobs report that we have. I hate to say it's old. It's been within the last 30 days, but this, and as we talk about it, I'll explain why. But this is the biggest report, not just for the week. This will probably be the biggest report for mortgage rates for the month. And it's only going to be eclipsed by the next jobs report that we get in February. It comes out once a month. But anyway, but like I said, you have access to all that. You can see the economic news coming out. If you're interested, that's the link at the bottom of again of my link tree here. But the ones that are really important are the ones as a real estate agent that I would encourage you to be cognizant of or be somewhat familiar with are these five reports right here. The BLS jobs report, that's the one I just highlighted for you. It comes out the first Friday of the month. Typically, this month was actually different. The first Friday of the month was January 2nd, but because it fell right after New Year's Day and all that, they didn't schedule the report to drop that day. I guess no one wanted to go in to the office on no one wanted to go into the office on New Year's Eve and New Year's Day to get that report ready to drop it on Friday the 2nd. So they're dropping it this coming Friday. But generally speaking, it's always the first Friday of the month. This is the report that you see about on the news when people are saying, oh, the US economy created 100,000 jobs or whatever. Like that is the BLS jobs report. It's a big deal. Investors pay attention to it. The market will typically move or swing. It creates volatility every time it comes out. There's two inflation reports I want you to be aware of. The first one is the most common one people have heard of, CPI or Consumer Price Index. It comes out towards the middle of the month, typically around the 12th or so. PCE, personal consumption expenditures, is another measure of inflation. It comes out at the end of the month. The GDP, gross domestic product, comes out quarterly, so we only get that one 4 times a year. And then finally, the Case-Shiller Home Price Index. That doesn't really move the market a lot, but it's, I think, a very good report to pay attention to as a real estate agent because it keeps up with home prices nationally as well as in specific sectors or specific markets like the South or Georgia or Atlanta. They look at lots of data points and add it all up to get to a national home price index. But it's good data to give someone who's data minded when they're saying, well, guys, they're going to be a pricing crash or a home market crash or what, real estate. Like it's just good data as a real estate agent to know. So let's break this down real quick. The BLS jobs report, it's actually two reports in one release. They release a business survey for jobs, and the business survey, that's where we get the headline jobs number. So when you see on the U.S. economy created 165,000 new jobs last month, that is based off the data from the business survey and the BLS, and BLS stands for Bureau of Labor and
We're
Statistics.
down the wrong pipe.
So it's literally the arm of the government that sits there and counts jobs and how much money people are making and all like that is what they do. So as you imagine, that's pretty big number. So that's where the headline jobs number comes from. Also built into that jobs report is what they call the household survey. So the business survey, they talk to businesses and model what they think is happening in the economy and report jobs that way. The household survey is just like it sounds. They literally pick up the phone and call. Um, you know, we got. Let's see if I can fix that, guys. Sorry. I think I just clicked the button to mute everybody, um, other than me. So I think we're good. Sorry about that. Um, the household survey is where they literally pick up the phone and will call different households throughout the nation and ask them, hey, are you working? How much money are you making? Are you thinking about changing? Like they have this whole survey they go through. And based off that survey, they then model what's happening in the employment situation and how many jobs we have and how many jobs we don't have and things like that. Okay. So it's two reports in one. We both get the headline jobs number and the unemployment number. This is also why, and it seems counterintuitive, but it happens. It actually happened on the last one. And as we get to the end of this class, I'm going to break it all down for you in bloody, gory detail. But you can have scenarios where the news anchor will get on TV and say the U.S. economy showed resilience as the jobs market data came in, and we created 200,000 new jobs. However, the unemployment rate actually went up, and it's because it's two completely different reports. So the household survey said that people lost jobs and the unemployment number went up, while the business survey said we created jobs. In theory, if we created jobs, the unemployment number should go down, but you'll get um, you know juxtaposed, or a dichotomy there. So it definitely happens, but it's because it's two numbers in one, and it's important to know that when you're hashing out what they're actually reporting in the news and what's going on. And if nothing else, it leads to kind of an interesting uh, conversation starter with someone who has questions about that. If you can say, well, here's why you get two different numbers, or again, if you're a nerd like me and you like discussing this stuff at a coffee shop, well, it's a great way to start a conversation. Um, so that's the jobs report. The CPI index, consumer price index, it measures the cost of a fixed bag of goods. The Bureau of Labor and Statistics goes around and they see what the average price is for a dozen eggs and a pound of ground beef. And like they have a specific box of goods that they track the prices on every single day. And then they use that to determine, are prices going up? If so, how much are they going up? And it's used to determine the inflation in the economy. The number that the Fed looks at is called the core CPI. That's where we take that fixed box of goods, but we strip out any eggs or ground beef or chicken, as well as gas or heating oil or anything like that. Um, so the core CPI, the Fed pays attention to that because they have come out and said that their monetary policy, what they do, and again, guys, we're going to get into the Fed more and how all that works later on in this course. But the reason that's important is the Fed has said that nothing that they do ultimately will affect food or energy, that those are just too sporadic and those prices are too all over the place for them to have a big impact on. But they're concerned with the prices of the other items in the CPI report. And so core CPI is more important to look at than the actual, what's called the headline CPI number. Um, yes, Jacqueline, you're right. The jobs report has been absolutely crazy, and I'm going to break that down and kind of give you my thoughts on that here at the end of the course. But you're absolutely right. The jobs report has been you don't even have to go back to April. You can go back 1 month. December's report for November jobs was just absolutely crazy. So we're going to break that down and try to read in between the lines and see what, maybe what it might mean for the economy and ultimately mortgage rates and then ultimately real estate. So we'll get into that. PCE, personal consumption expenditures, it measures spending on goods and services by U.S. households. The reason this one is important is it's the Federal Reserve's favorite measure of inflation. Um, So what's crazy is the CPI number gets all the headlines, it gets all the news, it's everything that gets reported. The average person, when they hear about inflation, they're probably hearing about it in terms of CPI. But that's not the number the Fed really looks at. The Fed looks at PCE. Again, I think it's important to pay attention to both. PCE is what the Fed's looking at to make their decisions. CPI is what you have to kind of know a little bit about to speak intelligently with a customer who's interested in this. GDP, gross domestic product, it measures the output of the entire US economy. A positive GDP indicates economic growth, while negative GDP indicates economic contraction. Generally speaking, this isn't set in stone, but generally speaking, two consecutive negative numbers of GDP is usually what means the US economy is in a recession. Okay. It's not always true. Technically, there's a whole arm of the government that makes that call and says whether or not we're in a recession. But in general, it's very rare that you have 6 months, because again, this data point only comes out quarterly, all right? So a GDP number reflects 3 months of US economy activity. If you have two consecutive negative numbers, that means you have 6 months of economic contraction. That usually means that we're in some type of recession for the economy. So GDP is a big one to pay attention to. And then finally, the Case-Shiller Price Index. This isn't going to have a huge impact on the market itself because it's just, reflecting data as kind of where our home prices. But as you can imagine, as a loan officer, as a real estate agent, having data that backs up what's going on for home prices can be really good to have a talking point for a customer, show them what's happening. I really like following this to overcome objections. And I've actually put this together. I only went back, I can pull up the actual chart and go back further. But this takes us back to 1988 or so. This is the Case-Shiller Price Index. This is home prices since 1988. Remember, I told you earlier that in recessions, home prices tend to do really well. Well, again, we'll call it the last four recessions. The 2020 recession, they called a short recession right after COVID. And then, of course, we all know what happened after that. Um, 2008 to 2010, yes, home prices did go down during that recession, but that's because it was home prices or the real estate market and the mortgage market that caused the recession, right? So it makes sense that there would have been a correction there. This recession back here, 2001, 2002, that was the dot-com bust. So it was the um, technological side of the economy that caused the recession. You can see home prices did just fine, actually went up during that recession. During the first President Bush's administration, we went through a small recession. Home prices were essentially flat. So anyway, I like the Case-Shiller Price Index mainly to tell customers what's going on and overcome objections. The only other real dip you've had in home prices, other than the mortgage crash that took place in 2008 and 2009, is we know home prices shot up very quickly after COVID. And when we got inflation data that showed inflation really was a problem, if you were in the market, most everybody here on this call probably was in the market for that time in the economy. You had mortgage rates literally go from 3% to 7% in about 2 or 3 weeks, right? I mean, it was just unbelievably fast how quickly interest rates went up and how quickly the market tried to correct for rates honestly being artificially too low for an extended period of time. So when that happened, you did see home prices slip down a little bit right after that rate increase came to our rate sheets. But as you can see here, we've more than recovered that, and we're on more of what I'm going to call a sustainable trend for home prices going up. If you look at the size of the curve starting about 2012 till about 2020, this kind of increase in home prices is very sustainable. That's standard home appreciation that we typically see in real estate. What we saw after 2020, how this shoots up much faster, that was not sustainable. And again, if you were in that market, again, I think most people were, it was real normal. I mean, like we're looking at homes that, a year before would have sold for $100,000 cheaper, and now they were $100,000 more expensive. We were seeing double digit, sometimes 15, 17, 18% home appreciation. That's just not sustainable, right? I mean, that was never going to last. But the trend we've been on since the rate correction, that is a very sustainable trend, in my opinion. And that's one of the things that I'm showing customers that are worried about, real estate crashing, or if they genuinely, you know, want to have a conversation with me about what I think is going to happen in the real estate market. This is one of the things that I show them, and it's one of the things I pay attention to. But again, I think this decade here of home appreciation that we saw is very sustainable. I think the trend we're in right now is very sustainable. So anyway, that's why I like watching the Case-Shiller price index. It doesn't really move the market so much when we get a new data point, but it is, I think, really good to have this information and this data in your back pocket as a real estate professional. Now, the reason all these reports and everything we've covered are so important is, does everybody remember this chart when I said, hey, this is the mortgage market and we've got these big candles and things? Well, day to day, there's going to be movement. There's investors moving money around. Do we invest in stocks? Do we invest in bonds? Like what's going on? But the big, big, big candles that you see, it's typically happening because of a big economic news report that came out. So this big green candle right here back in January, this is January of last year, guys, by the way, when I put the slide together, that was a CPI number that came in really good. January 22nd, we got a good GDP number that showed less inflation in the economy. This was beginning of February here, we actually had a really good jobs report, showed a bunch of jobs being created. But remember, good economic news is typically bad for mortgage bonds. And as a result, we saw the market sell off. And remember, it's counterintuitive, but red candles are bad. Red candles mean interest rates are going up, right? So we had a strong jobs report, showed more strength in the economy than we were anticipating. We saw that spark fears of more inflation in the economy. And as a result, we saw the mortgage market sell off and interest rates went higher. This huge red candle here in the middle of the chart, that was a big CPI report number that came out, and it showed more inflation in the economy that investors were specifically worried about. So anyway, typically big candles can be attributed to economic news, not just the day-to-day movement of investors putting money, stocks, bonds, investing in mortgages, not investing in mortgages, increasing their portfolio, decreasing their portfolio. But news makes a big deal. It's also why, in my opinion, good loan officers know when economic news is coming out and they've informed their clients accordingly. It's a really tough conversation, I think, as a loan officer to have to call a customer and be like, hey, your interest rate's gone up. Well, why did rates go up? Oh, we had a big jobs report. Well, did you know the jobs report was coming out? Well, I did, but I didn't tell you, or I didn't know because I wasn't paying attention to it. Again, I think that's a big part of the job that has to be taken very seriously. I assure you, my customers either know they're floating into these reports or they have been informed one way or the other. Sometimes I'll advise them to float, sometimes I'll advise them to lock, but I promise you, my customers know what's going on. Let's see here. Do you see a trend to extend mortgage terms coming soon as a way to make homes more affordable? Jason, it's a good question. The answer is no, I don't see that happening. When you extend a mortgage term, everybody's probably seen this data. I could pull up a Google search page and just, type it in and you'll see it. 30-year mortgage is a long time to have a mortgage. Yes, Michael, this is a bond market chart. So this is directly what impacts our interest rates on our rate sheet. So a 30-year mortgage, if you make the minimum payments across 30 years, you're going to pay a lot of interest on that mortgage, right? I mean, it's an extended period of time to be paying for a mortgage, to be paying an interest rate. To extend that to 40 years or 50 years, believe it or not, it has very little impact on the monthly outgo for the customer. And it has a little impact, but because you're now paying extra interest for 10 years or 20 more years, the amount of interest that you pay is even more exorbitant than it would be on a 30-year mortgage. What the market actually did, because that product did try to kind of sneak into the market, it never really took off. Back during 2005, 6, 7, I don't think I ever closed a 50-year loan. Fannie Mae did come out and offer a 40-year term, a 40-year amortization loan. But what actually took its place, if everybody remembers from being in real estate back then, everybody remember when we did loans interest only? Remember that? If you think about it, interest only, it's not a 15-year or a 30 or a 50-year term, it's an infinite year term, right? Like interest only means you just pay interest for the life of the loan. You'll never pay it off. It's just interest, 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 interest. All you ever pay is interest. Well, yeah, the payment's as low as it can be when you still are offsetting the interest, but you're not paying anything towards principal. And then they even came out with a product after that to even be more pricing aggressive than that, which was a negative amortization loan. And that was where you literally paid less interest than what was due, and any interest you didn't pay was rolled to the back end of the loan. So if you made the minimum payment, you would go from owing $200,000 on your home to $200,500 on your home. And the next month you'd owe 200,000 or $201,050 on your home, and it would grow exponentially if all you made was the what they called the negative AM payment. Um, when all the new rules and everything went into effect after the mortgage crisis, and the fact that I now have to have a license and just everything that unfolded from that situation, um, the any mortgage that's longer than a 30-year term is classified as what we call a non-QM mortgage. And there's a whole bunch of rules and regulations, and it makes it really hard to close those types of loans. So not only do I not see it coming back, those types of loans are pretty much regulated out of the market right now. So very long-winded answer. I apologize, but all that to say, no, I don't see 30 or 40-year or 40 or 50-year terms or any extended terms hitting the market. We're kind of locked into 30-year fixed rate mortgages, I think, in perpetuity. Let's see. Edith, oh, that was a direct message. Let's talk offline. You get my contact information, and we'll discuss that, okay? But yeah, it's the short answer is it just depends. All right. So moving along here, guys. So we've talked about how the market moves, the different jobs, and everything. So everything that we've talked about, and we've kind of hinted at it a little bit. But now let's get into, okay, what role does the Federal Reserve play? And one of the biggest roles that they play is the fact that everybody's heard about it because it's all over the news, right? Like, everybody knows, everybody posts on Facebook or Instagram or whatever when the Fed raises rates, cuts rates, pauses rates, like whatever. But, you know, what I've learned is that, and again, guys, I'm not poking fun at anybody. Um, I think in general, everybody, and it's inevitable when we're talking about the Federal Reserve, it's a government entity. It's going to lead to the conversation turning a little bit political. I'm going to do my best to avoid politics as much as possible. Other than saying that one of the things that cracks me up the most is when I'll be at a restaurant, having a drink at a bar or at a baseball game, whatever. And you end up talking to somebody, and it leads to something about, oh, the Fed cut, and here we go. Oh, the Federal Reserve, and they're just a bunch of communists, and they just want it like it. And whoever it is, they don't even know what Federal Reserve actually is. Like what is it? What are we talking about? What's going on? So and that's okay. I mean, it's not like I don't remember being taught how that worked when I was in high school, right? I mean, we learned about, you know, rhombuses and parallelograms, but we didn't really learn about the Federal Reserve other than maybe you might remember from US history class that, Andrew Jackson didn't like it or something like that. So anyway, so let's break down what is the Federal Reserve, what is their function, what do they do day in and day out, and then ultimately, what of the decisions they make, how does that impact our overall economy, and then how does that trickle down into the mortgage market and therefore into real estate? Okay, so the Federal Reserve is one giant U.S. central banking system. Okay, under the moniker or under the whatever you want to call it of what the Federal Reserve System is, you have three key entities. You've got the Federal Reserve Board of Governors, you have 12 Federal Reserve banks, and then you have the Federal Open Market Committee. So when you say the Federal Reserve System or you say the Fed, we're actually talking about three separate entities that all make up the Fed. They have five key functions: conducting the nation's monetary policy, helping maintain the stability of the financial system, supervising and regulating financial institutions, fostering payment and settlement system safety and efficiency, and promoting consumer protection and community development. So that's, and I pulled this directly off the Fed.gov. So this is their little chart that they like to show you. The Feds, most people don't know this, but when you wire money, like for a real estate closing, or you're just wiring money from one bank account to another, every wire goes through a federal bank before it ends up at the bank where it ends at. And that's why all wires have what we call a Fed reference number. And that's how we know the wire went through, because we've got the reference from the Fed that they received the wire from, say, Bank of America, and then turned around and put it in an account that belonged to, say, Truist or whatever it is when you're wiring between two different banks. But all wires actually go through a Fed bank. That's so where they can supervise it and regulate it. And hopefully it's a way for them to get out in front of wiring fraud and things like that. So most people don't know that. But that's what the Fed is. Just so where I think this is kind of interesting. This is the 12 Fed banks where they're the geographic regions that they're responsible for. No, Regina, actually, it doesn't matter if money is wired at all. It goes through a federal bank, period. The $10,000 rule you're talking about, that has to do when a banker or teller has to file a SARS report, I think. There's some other thing about that. But all wires go through the Fed. And the other thing, if you have the other reason I like to show this chart is if you have a piece of money on you, the Federal Reserve, this is where they actually print our dollars. And you can look at like a dollar bill that you have, and it will tell you at which Federal Reserve Bank it was printed. So this dollar bill that I'm holding, and I don't know, I'm sure the screen's small because I'm sharing my screen. The dollar bill, this particular one has a D on it on the left-hand side, and it actually says Federal Reserve Bank, Cleveland, Ohio. So this dollar was actually printed at section number 4 here, Cleveland, Ohio. You can figure out which bank your dollar was actually printed at, and it's going to be one of these 12 banks where they actually print the money that they put into circulation for the U.S. economy. So, like I said, just a little data point there. Doesn't really affect anything, but it's just one of those, if you're a nerd like me, it's kind of an interesting thing to know. So anyway, this is where the 12 Fed banks are located. and who they are, the geographic areas they're responsible for. What you have, so the way the system works is Congress technically oversees the whole system, and everything answers to Congress. You have a board of governors, it's an independent agency of the federal government. And then you have the Federal Reserve banks. Each Federal Reserve Bank has a president of the bank. Okay. And the Federal Reserve Bank presidents plus the Board of Governors makes up the Federal Open Market Committee. Now, the Federal Open Market Committee is who we're going to talk about for the rest of this class when we're talking about the Fed, because this is the committee that votes on and discuss data about and makes decisions on monetary policy that then leads to the news reports that we hear where the Fed cut rates 25 basis points or 50 basis points, or they pause, or they like it's the Fed funds rate, the rate that they control, is controlled by the Federal Open Market Committee that consists of the Federal Reserve Bank presidents and the Board of Governors. Now, I'm willing to bet money that the majority of people on this call didn't know that's how it works. And typically, when people say the Fed, we're talking about what the Fed is doing with changing interest rates. Therefore, we're talking about the Federal Open Market Committee. Okay. So when we say that, that's when I say the Fed, that's what I mean. I mean the Board of Governors plus the Federal Reserve Bank presidents that are making decisions about monetary policy for the US economy. That's typically what most people mean when they say the Fed, even if they don't even know what they're doing or what's going on. Moving along here. The Federal Open Market Committee, the chair is Jerome Powell. Everybody probably knows that. You hear his name in the news all the time. There are always 12 voting members that are their votes count towards what they want to have happen towards interest rates. Okay. You have Chairman Powell who votes, you have the 6 board governors, you have the New York Federal Bank president, he always gets a vote. And then they round out the rest of the voting members with 4 of the remaining 11 Federal Reserve Bank governors or Federal Reserve Bank presidents. The reason the New York Fed Bank governor always has a vote, you got to understand this system was set up 100 plus years ago. And the reason they wanted banks at in individual sections of the country is the idea is that that bank was supposed to say, oh, this is the economy and what's going on in the South. And the other bank governor would get data and say, well, this is what's going on in the Midwest. And then they would rotate votes because, one Fed president at one bank would say, well, no, my economy needs this, but the other one would say we need that. So they would rotate it. But the New York Fed Bank governor always had a vote because he oversaw the New York Stock Exchange. And because that's such a big economic entity within the nation, his vote always counted. Does that make sense? So that's how it works. There's 12 voting members every year. And one of the things I pay attention to is of these 4 people from the other reserve banks who rolled off the docket, who rolled back on the docket, and kind of how do they tend to vote when it comes to rate increases or rate decreases and things like that. If I pay attention to it, I assure you other investors that actually make a living doing these investments pay attention to it. We have an idea just based off when they speak and news conferences and all that, who how the Fed bank governors are going to vote when they have a Fed meeting to change interest rates. And we also kind of know up front how that vote's going to play out based off whose vote actually counts for that meeting. Okay. So anyway, that's the Federal Open Market Committee. There's 12 voting members. The Federal Open Market Committee, they have a two goal, or they have what's called a two, there's some government word they give for it, a two-pronged approach or a two, anyway, they're tasked with 2 goals: 100% employment and total price stability. Which makes me thrilled that I am not a member of the Federal Open Market Committee, because there's no way you'll never have 100% employment in the economy. You'll never get there. and you'll never have 0% inflation where you're not in deflation, stagflation, where prices are going down, but prices aren't going up. I mean, how great would that be? Every time you go to the store, the gallon of gas is always exactly the same price. The gallon of milk's always the same price. The carton of eggs always the same price. Well, it's not realistic. It's not going to happen, but that is the goal. So their monetary policy is set up to try to have as many people employed and working in the economy as productive as absolutely possible while prices are being stable and we're not spinning off with increases in inflation or deflation or anything like that. Okay? So that is the goal of the Federal Open Market Committee. Now, the way they achieve that goal is they control the Fed funds rate. And the Fed funds rate is an overnight interest rate that banks borrow money at to meet deposit requirements. So if you have ever signed up for a bank account, I imagine everybody here on this call has a bank account. You probably have seen or you see on signs outside the bank or whatever that the bank is FDIC insured. Everybody seen that FDIC insurance? Well, what happens is the bank, when they lend money, they have to, at the end of the day, at the end of their business day, they have to have a certain amount of money on deposit in order to meet their deposit requirements to maintain that federal insurance. And you can't run a bank without it. So they always meet their deposit requirements. If they happen on a given day to lend out more money than they needed to, and they don't have enough deposits on the books, they can borrow that money from other banks, but the rate they pay overnight to borrow that money is the Fed funds rate. That's the rate that the Fed controls. Okay. So you got to think, just knowing that a 30-year fixed rate mortgage that a customer is paying to own their house that's going to last 30 years, yeah, it has an interest rate on it. But when we're talking about the rate that the Federal Reserve controls, and that being an overnight rate that banks borrow from each other to meet deposits requirements, yeah, they're both interest rates, but they couldn't be more night and day different instruments. Does that make sense? Like they're just, that's why when you hear in the news the Fed cut rates, everybody's like, oh, it leads to two problems in the social understanding or the public understanding of how interest rates work. One, there's this idea that there is a person or a human or a group of people somewhere that just determines what rates are. It also leads to a bunch of people saying, oh, well, when my presidential candidate gets elected, he, she, whatever is going to make rates better because there's this concept that an individual controls the rates. Well, you just saw from previously in the class, there's a million variables that go into what creates a mortgage rate, and it has to do with supply and demand and where is investing and what are we doing. It doesn't have anything to do with the Fed funds rate. However, the Fed funds rate absolutely can impact the economy and can impact our market. So let's talk about that real quick and kind of explain how it works. And guys, again, this is a little bit technical, but hopefully it'll lead to some understanding. The first thing is you have to understand how a bank works or how our banking system works, understand what's going on. So if you think about it, if you're a bank, how do you make money? Well, it's real simple, really. If you're a bank, what you want to do is you want to collect money or get money at a low interest rate and then lend that money out at a high interest rate. So money comes in at a low rate, money goes out at a higher interest rate. The difference in the interest rates that you're paying for the money that you bring in versus the interest that you receive for the money you lend out leads to the bank making money. They make a profit. That is what a bank does every single day. Now, if you think about it for you individually. Why do you have money at a bank where you have money? Well, some people do go around and shop banks, right? About, oh, this bank's paying more interest. This bank's their CDs higher, or their whatever. So sometimes it actually is raw interest rates. But a lot of times banks, the money they pay for the money they bring in isn't in the form of interest. It's in the form of a free checking account, right? The fact that for free, you have online access to your account and you have a debit card and they give you free checks and all that kind of stuff. Well, that service isn't free. It actually costs the bank money. And a lot of times they can bring in the deposits they're looking for on those accounts without having to offer an interest rate to you. Because when you put your money in the bank, what you're really doing is you're lending the bank your money. Make sense? Like that's what's happening. The bank then takes that money and they lend it out at higher interest rates, and the difference is the profit that they make. Now, obviously, if the bank needs more money because they've got something, they can offer higher interest rates to encourage more deposits to come in. Of course, those rates that they're offering, they have to pay out. So they have to make sure they're making more than that with the money they're lending out. So in general, that is how a bank makes money. When the Fed raises rates, okay, the banks have to raise loan rates to make money. Because what happens is if a bank is sitting there and they're sitting on deposits and the Fed has raised interest rates, they know that they can lend that money overnight to other banks and make at least that interest rate. Does that make sense? Because the Fed has set what the banks borrow money for between each other. So when the Fed raises rates, banks end up their loans, the rates do go up. They have to raise loan rates to make money. They have to offer higher interest rates to attract deposits. Because they are offering higher interest rates, consumers are now incentivized to save money instead of spend money. Raising rates slows down the economy because it destroys some of the demand. A customer who could have spent that money to go buy a car or go buy a new gadget or a piece of technology or whatever, they're going to be incentivized to not spend that money if they're earning better interest by leaving their money in the bank, right? As the Fed rates go up, not only did the amount of money you pay for loans go up, but the amount of money you make in your bank account should also go up as well. Interest rates go up across the board with the bank when they raise rates. Um, when that's when they kill demand or as they're destroying demand by raising their rates, it leads to less price increases because there's not as much going on in the economy. It also can lead to less jobs. Companies may not take out a loan at a big interest rate to go expand a factory or build a new branch or take on some new item or what it's more expensive for companies to operate, so it forces them to maybe delay plans, change plans. As the Fed raises rates, it absolutely destroys demand in the economy. And when you hear the Fed talk, if you again pay attention to if you have trouble sleeping at night and you want to read a Federal Reserve governor's you know press conference or whatever, they talk about how the Fed rate is effectively restrictive. And by restrictive, they are literally saying we are destroying demand in the US economy because the rates that we have set are too high to keep companies from doing something that they otherwise would be doing. That's what increasing a Fed funds rate does. Okay. So conversely, when the Fed is lowering rates, they're trying to increase or stimulate demand into the economy. It creates more economic activity that can lead to more jobs. But as we have more jobs and more economic activity in the economy, there's more money in the economy, and that additional money in the economy can be inflationary. So their two-pronged goal of having 100% employment and 0% inflation are always fighting each other with the Fed funds rate either being higher or lower. Higher rates should lead to less inflation, less price increases, but it's going to lead to more unemployment. Lower rates should lead to more economic activity, more employment, but that leads to more money in the economy, which leads to potentially more inflation. Now, with that said, remember our investors that are always trying to figure out what's going on and where we should have our money, stocks, bonds, things like that. Well, based off what you know now and from this class up to this point, um, let's think about what's happening here. Okay. The Fed steps in, and we're in a cycle right now where the Fed is actually cutting interest rates, right? That's what's going on. The Fed has been cutting interest rates. They've cut it the last several meetings. Why is the Fed cutting interest rates? Well, they feel like that they've been reasonably effective at slowing down some inflation in our economy, and they're trying to stimulate more demand. Well, if we're stimulating more demand, the cutting rates, it used to be really expensive to build that extra factory, but now since rates are lower, it's a little bit less expensive. It's going to lead to maybe more economic activity, more jobs. If I'm an investor and I hear the Fed's cutting rates, where am I going to push my money? Where do you think that money would go? Stocks or bonds? Absolutely. It's going to go to stocks. So in a very real sense, and what is happening right now in our economy is the Fed is cutting rates, but we still have had, headline good job growth, good numbers. The investors are looking at this and they're saying, well, we've got people working, people want to work, there's more money in the economy, the Fed's cutting rates, da 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 da. They're moving money into stocks, and that's why you haven't seen mortgage rates really improve since the Fed started cutting rates. In fact, mortgage rates have actually gone up a little bit since the Fed went into a cycle of cutting rates. Now, again, from a sales standpoint as a loan officer, I'm not getting on Facebook trying to tell people, well, this is what's going on. And this, if a customer picks up the phone and says, hey, I've been thinking about buying a house. I heard the Fed cut interest rates. I wanted to see what it was like. Absolutely. We'd love to quote you an interest rate. Let's get a loan application. I mean, if it stimulates the customer wanting to call me to get a loan, I'm not going to spend 30 minutes trying to explain them why that's wrong, but I still want to do a loan application for them. At the end of the day, the Fed cutting rates is really good for hopefully getting someone off the fence who was on the fence about buying a house because they think about doing it, right? But fundamentally, what's going on right now, it is leading towards higher interest rates. And we're seeing that on our rate sheets day in and day out. The other reason that this is a problem is that, again, as the Fed cuts rates and there's extra economic activity, that does lead to more inflation. And guys, I'm still trying to learn where to put this slide in the course here because inflation is a big problem and it's something that has to be understood, but it's a wild card that kind of makes understanding what's taking place a little bit complicated. But let's talk about it real quick. So, what is inflation? At the end of the day, inflation can be defined as too much money chasing not enough goods. Okay. So, let's, for example, say you have two customers. Let's make it real simple. You've got two customers at a dealership wanting to buy a new car, but there's only one new car left. And let's say the sticker price for that car is $50,000. And both customers have $50,000 to buy the car. Well, from an economic standpoint, for economic output and economic, productivity, in a perfect world, the dealership, BMW or Mercedes or Ford or whoever it is, in a perfect world, they would have had two cars to fit the demand of the two customers that had the $50,000 to buy the car that was priced at a $50,000 price tag, right? Like that would be ideal. But when you have two customers wanting to buy it and there's only one car left, well, what happens? Well, fundamentally, economically, one customer says, oh, well, I've got $51,000. And the other customer says, I have $52,000. And then finally, one customer gets priced out of the market and the other customer buys the car. Let's say they buy it for $55,000. Well, from a raw number standpoint, it looks like the economy is doing better because now you had the economic output of a $55,000 car instead of a $50,000 car. The problem is that it's the same car, it just sold for more money. Make sense? That's inflation. Inflation is the same productivity, sometimes it's less productivity being sold for more money than what it was sold for previously. Okay. The problem with inflation is, remember, for bonds, for mortgages, these are fixed rate investments. The investors have signed up and they know they're going to get 4% or 5% or whatever it is that they've negotiated as a return on that investment. Okay. Well, inflation destroys fixed returns because you know you're going to get, say, 3% on your money as a fixed return. But now, as you're getting that money over 5 years or 10 years or 20 years, depending on which bond you bought, that the money that you get back is eroded in value because that car that used to cost $50,000 now costs $55,000. Make sense? The carton of eggs that used to cost $3 now costs $4. So even though you made a return on your money, a fixed return, if inflation is high, you end up losing money in bonds, right? So inflation is what makes bonds risky. Does that make sense? Stocks are risky because companies can go bankrupt or make bad decisions or not sell as much as we thought they were going to. We can make a mistake when we invest in a company. With bonds, we can make a mistake if inflation goes higher than we're anticipating it. Okay. So when you have high inflation, and we had extremely high inflation coming out of COVID 20 into 21, 22, investors immediately required higher rates and demanded higher rates to be able to fund mortgages because the mortgages they were funding at 3%, that's money that they are absolutely going to lose money on because when they get that money back, it's not going to be as valuable as it was when they originally bought the bond. Does that make sense? So inflation always leads to higher interest rates. Inflation always leads to problems in the mortgage market. And the other thing you have to remember with the economy we're in right now, don't discount the fact that what we did during COVID, so 2020, economic shutdown, all the levers we pulled and the way we just pounded and pounded and pounded on the economy, we're still, in my opinion, getting out of that and living with some of the results with the money that the government spent and some of the things we did coming out of coming out of COVID. The Federal Reserve right now is holding big mortgage balance. So the reason mortgage rates were so low is the Fed was actually buying these mortgage bonds at really low rates and holding on to that paper. So you had an extra big buyer in the market and with demand that's not normally there for mortgage products. So, they're slowly moving those mortgages off of their balance sheet and trying to make their paper and their portfolio look a little bit more normal. But everything that we did in 2020 and 2021 to stimulate the economy directly led to all the inflation we've had in the economy since then. And that's directly impacted our mortgage rates and why we've gone from prior to COVID. Like, I don't know if people remember this, but 2019, before we even knew how to spell COVID or knew what a SARS virus was or whatever we decided to call it, mortgage rates were staying at around 3%. Like, we overall had really good mortgage rates then. Um, you know, we've settled out with all the inflation now, what mortgage rates pretty consistently for the last, year or two, probably been what mid sixes to sevens. Sometimes during a really bad set of economic data have been, high sevens or even as high as eight. But the uh, the inflation in the economy, and that was why the Fed had to raise rates to kind of get out in front of that inflation. But overall, the concern right now is because we still have had good jobs reports and we've still had, you know, the Fed saying, "Hey, we want to cut rates." That's leading investors to say, "Well, dang, we might spur more inflation in the economy," and that's why we haven't seen mortgage rates come down yet. Okay, so back to our investors now. So when the investors are looking at what the Fed is doing, that's just another variable in their wild card again of trying to figure out what's going to happen with stocks and bonds now, or how they're going to move their money around. The guessing at what the Fed is doing and their stance ultimately affects the supply and demand that investors have either for stocks or bonds or vice versa. Now, another chart that I want to show you though, and this is kind of, it's good news to know, and also is kind of slowly going to get into, my projections for this year and kind of round out the class here in the next, 30 minutes or so. So this is a chart right here. I've already showed you this once before. So it's the average 30-year fixed rate over since about 1970 or so. That is the red line. Okay. The blue line is the Fed funds rate. So this is what the Fed has done with their interest rates. Something I want to show you is you can see here 19, 80, 82 or so, the Fed went through, and that was when Paul Volcker was the Fed chairman, and he did all kinds of stuff. A lot of people say he's the best chairman we've ever had. There's probably a whole economic history that can be written about this time and the crazy swings here in the Fed rate. But the general trend I want to show you is that fundamentally they raised the Fed rate, and then you see after that the red line goes down. Mortgage rates go down. Okay. Same thing here, 1985, that blue line goes up. After it, that red line goes down. Do you see that? To what's this, about 1988, 1989, right before 1990? Fed funds rate goes up over time. That red line, the blue line goes up. After it, the red line goes down. 1995, blue line goes up, red line comes down. In general, when the Fed is raising rates, that leads to a market in the future where mortgage rates typically come down, right? We haven't seen that just yet. So even the most recent two times the has raised rates, you start back at 2015 up till about 2018, they started raising that Fed funds rate. We saw mortgage rates come down thereafter. Then we have 2020, the Fed funds rate fell to zero essentially and stayed there for 2.5 years. We saw mortgage rates go up. Since then, we know that the Fed started raising rates very quickly. We haven't seen mortgage rates come down just yet. And what's interesting is we've already started cutting the Fed rate now. That's the very tail end of that blue line. So it's an interesting market, but again, some of the challenge or some of the headache with trying to project what's going to happen or kind of give you my thoughts on the future is it can't be overstated how hard we slammed our economic system and the things we did in 2020 to combat COVID and the economic shutdown and everything that happened during that absolutely crazy year that hopefully we don't ever have to live through again, right? Um, so it's uh it's really an interesting time to try to make a call or kind of look into the future and predict the future. What I will say is fundamentally, I still like the idea of mortgage rates should go down after a cycle of Fed rate increases. The reason that happens is when the Fed raises rates, they're usually stamping inflation out of the economy. And as inflation gets under control, you typically see a good appetite for mortgage bonds because they perform well and they offer better returns than typically corporate bonds or government bonds. And it also stimulates the economy because people buy more real estate when rates are low. It just makes sense that they would do that. Um, Looking ahead, I think I forget who it was. Someone mentioned the jobs report previously, and I think we need to talk about that. So I told you that the biggest report coming out probably for the whole month is the jobs report that comes out on Friday. But the reason I say that is let's kind of talk about the most recent jobs report. So the most recent report came out in early December. The headline number from the business survey showed 227,000 jobs created, but the household survey showed 355,000 job losses. So you have two reports in the same jobs report the day that it's released. One of the reports says we created 227,000 jobs. The other one says we lost 355,000 jobs. If you look back at the jobs report in November, they revised that number to say we created 36,000 jobs, much lower than December, but that number was shrugged off because they knew that number was going to be impacted. That was when, what was it, Hurricane Helene had gone through and created problems, and there was like a big strike at some other part. Like there were reasons that the investors in the market and people who were looking at this number Actually, a lot of people were expecting the November jobs number to be negative. The fact that it was positive at all was looked at and perceived as a big jobs number, shows big economic growth in the US economy because based off the weather events and the strike events, they were actually expecting negative jobs on that report. Again, in the same breath, though, the household survey that was released in November, it showed 368,000 job losses. So for the jobs outlook and what we have in jobs reports, you have a gap of almost 1 million jobs in just 2 months of data between the two big jobs reports that we make decisions on in the in our U.S. economy. That is really, really hard to reconcile, in my opinion. I don't I'm pointing it out to say that it's there. That's what the data is. In my opinion, I mean, we're eventually going to get enough data and we're going to see enough economic activity or lack of economic activity to figure out that one of the reports was more right than the other. But there's no way to reconcile this. You're not going to be able to come back a year from now and say, look at these data points and say that, oh, yeah, well, both jobs reports were right. They're just two completely opposite direction reports. So again, figuring that out, or and I say figuring it out, you have to understand the economy is doing what it's doing in real life, right? Like, I mean, whatever is happening. Um, it's just that when do we as a you know, society figure out what's going on and then make the right moves accordingly, right? If we really are creating all these jobs and it's the household survey that's wrong, we're going to get data that has more inflation in the economy. We're going to throw out the household survey. We say, something's wrong with that model. We need to fix it. But, you know, that inflation will show up. The investors will require higher interest rates that will lead to more more mortgage rates going, staying the same or going even higher because you've got all these jobs and all this money in the economy that can be inflationary. If we determine that the household survey is correct and we're losing these jobs, you're going to have more customers trying to save money before they lose their job. We're going to see that in the data. You're going to see people start to go late on credit cards, and we monitor that. You're going to see people start missing payments. You're going to see the economy slow down where people aren't buying stuff because they're just trying to make ends meet. And then that's going to be very good for inflation, which will be good for rates, and you'll see mortgage rates go down. So there's going to be a reckoning here between the two reports. And it's why I'm personally fascinated to see what the jobs report says on Friday this week. Because I have no idea. I don't really know what to expect because the reports have been so opposite of each other. But it's fascinating. It's a fascinating time to watch this. And I think some of it is you have to understand, as good as they are at looking at this data, they're not going through and calling every company every day and finding out who quit and who was hired and how many you're trying to hire. I mean, you just can't do that. They model this data with these jobs reports. And I think what you have is you've got something fundamentally flawed in the model that's not being accounted for. And I think it's a model that probably works most of the time, but it's a model that doesn't work right now due to how hard we hit the economy and the way we impacted things after COVID. I think that's still working its way through and working through these models before things finally settle down. It's like if you rear back and hit a machine really hard, or actually my background's in chemical engineering, so I go to that. Like if you just instantly shut off or change something in a chemical reactor for a while, then turn it back on, it takes a while for the system to kind of settle in and get back to like a steady state operation. Um, so that is fascinating for me. I saw some questions. John, yeah, there definitely, I agree that something is flawed in the model right now. And again, I don't think that I mean, it's kind of a hard thing to do anyway when you're trying to count how many jobs there are in the US economy. I mean, it's a difficult task that they're challenged with. But I think rules of thumb and some of the assumptions and some of the things that go into these models that were sound assumptions back in 1990 or 1995 or 2015 don't work as well in 2023 and 2024 when we're coming out of kind of what we did during COVID. Um, Nona, how does holiday spending fall into the equation? It doesn't really. Holiday spending is adjusted for as a seasonal adjustment. So they kind of account for the fact that there's going to be extra spending at that time. Now, the way they account for it, if they see that spending was significantly higher than what they expected it to be based off the seasonal adjustments, that can be read as inflationary. That would show up in your what's that called? There's a like a consumer spending report or like a purchasing report. I forget the name of it. I don't follow that one quite as closely, but they do account for seasonality and things like that. Let's see. Explain what means commercial borrowers buy down the rate. Um, some tough choices. 2025. So Eva, that has to do with I think some of that data, in all honesty, is overblown um, about commercial borrowers and the fact that they had like a reprieve. It was also overblown. The better example that I think is more impactful for our market is, remember during COVID, they allowed people to defer a mortgage. You could just call up the mortgage company and be like, yeah, it's COVID. We don't, want to make a payment. And they had to do it. Like, I mean, there was no metric. There was no litmus test to see if you actually had a problem or an issue. You were just allowed to defer your mortgage. And there was a big thought out there. It's like, oh, well, that program's coming to an end, and all these people are to go into default, and you're going to have extra foreclosures in the market and blah, 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 blah. Like, we never saw any of that come to fruition. Okay. Um, Anything that you see in the commercial market that goes downhill, in my opinion, will just be due to a fundamental lack of demand or just a changing fundamentals in the commercial real estate market. I actually thought it was going to be worse. I thought more and more people would demand to work from home instead of going into an office. But and kind of when I was talking about different things and teaching classes in 2022 and 2023, I brought up some reports about that and how that might impact real estate. But overall, it looks like, yeah, I mean, there's some jobs that people do from home now that they used to do in an office that they'll always do from home. There has been some fundamental shift, but overall, a lot of the majority of jobs, it's people back at work. So I still think there's pretty solid demand for commercial real estate. And so I don't personally foresee like a big real estate crash at all, commercial, residential, or otherwise. There's just too much demand for the real estate we have, and I think we all know that even at 7% interest rates, and there are not as many buyers in the market, you still have the problem of when you have a buyer finding them the right home because we don't have lots of inventory. We've got more inventory than we've had in a little while now, but overall, there's reasons for that. There's a whole nother slide I could show you about that, but in general, we just didn't build enough residential real estate after the financial crash in 2010 to keep up with the demand of the population growth that we've had, and we're kind of paying the price for that now. Um, Linda, you're so sweet. I'm not sure. I think this class is being recorded. I'd have to see if it does, and have to get it uploaded into YouTube. I'll see what I can do. All right, no promises, but I'll see what I can do. So anyway, moving along, you've got this crazy reckoning that has to happen with the jobs report and trying to figure out where the economy actually is. I personally think that the jobs market is a little bit weaker than the headline numbers. A lot of the jobs that I feel like we're catching in the jobs report are part-time jobs where people are either supplementing their full-time job to be able to pay for the fact that crap is more expensive now than it's ever been. But that looks like a new job to the report. Makes sense? Someone who has a full-time job, but then they start picking up shifts as a server or bartender on the weekends to make some extra cash to pay for their kids to do swim team or whatever it is. That shows up as a new job created in the economy. But again, I think that's kind of like a fake job, if that makes sense. They're taking that job so where they can still consume at the same amount they were used to consuming at when they only needed one full-time job to do it instead of a full-time job and a part-time job. We're also seeing when we have, job losses, because there are job losses, uh, we're seeing some of the job losses being full-time jobs, but some of the jobs that we're counting as new jobs that make that headline number look good, it could be a part-time job. It could be a seasonal job that an 18-year-old took. So it's I personally think, I don't know if it's as bad as the household survey. I think negative 368,000 jobs in a month is a huge number to try to digest. And I don't know how accurate that is, but I think the actual number, what we're going to start responding to economically, is going to be a little bit bleaker picture than what we're seeing or the way we're responding to it now. But you have to remember the mortgage paradox, which is if things are a little bit worse, that actually does trend towards better interest rates, right? Um, so it'll be interesting, but that's kind of my gut feeling and just trying to read in between the data and trying to understand what's going on with these reports. I think we're giving too much credence to part-time jobs, not enough to the full-time jobs. And but a job, for sake of the report, a job's a job. And obviously, I think that's a flawed way of counting jobs. Um, I've mentioned this before. I do think we're still experiencing COVID shock. I do think that inflation is better than some of the current numbers. What you had, I mean, guys, there's not really been many times in US history where home prices went up as fast as they did for as long as they did during the market of 2020 and 2021. And you have to remember that it wasn't that the home was all of a sudden worth 100 grand more, which we saw like a year later. It was because you could finance that home at a 2% 30-year fixed rate mortgage, which that is not a logical interest rate that anyone should have ever been able to get. And anybody who's smart, if you have a mortgage like that, I recommend you never pay it off. Just keep paying that 2%. It's like less than free money. It's like money they're giving you. So anyway, all that to say that shelter, the cost of houses, the cost that people pay to live is part of the inflation reports, both the CPI and the PCE. But home prices went up so fast, the way that model works, I think that you have this lag effect where you're not really capturing the real price increases in real estate right now. I think that home prices and the amount of money people pay monthly to live has been pretty stable. But the way these reports look, it looks like shelter keeps getting more and more expensive every month, which is making the inflation number look higher than it actually is. So I think both of those things tend towards, and I'm not just saying this because I want to believe it. I really do believe that inflation is a little bit better under control than what some of the numbers are saying. And I do think that the jobs outlook and the employment situation is a little bit bleaker than some of the other numbers are saying. I think there's probably some investors out there, certainly there's some, but I think that's kind of the mindset we're getting towards um, in the overall economy. A big wild card we have, and again, guys, I told you I was going to try to keep this unpolitical, but it's just the truth. We all know we've got a new president that's going to be sitting in the office here soon, right? Um, Personally, I don't I don't really know what the plan is going to be. I don't know what you know policies are going to get pushed through. One of the first times that I can remember, and I don't follow politics anywhere near as well as I used to, but I remembered thinking, I mean, it's politics, it's mudslinging, and this person's terrible, and that guy's terrible, or whatever. That's part of our system. And I do think it's one of the best systems in the world for everything that's wrong with it. Um, but for example, recently we had a number come out for manufacturing that was higher than expected. And the initial reaction to that number was, oh, wow, these factories have had more orders and they're producing more orders, and that can be inflationary. So we saw mortgage rates actually increase a little bit on the report. It wasn't a major report, but it was something that we saw that happen. But when you look at the actual data, what you had is you had these companies placing orders, and they're actually placing orders now to fulfill demand that they expect in the future that they normally wouldn't place the order yet. They would have waited. But there's a concern that with the new presidency, they might actually enact some tariffs, and those tariffs would make things more expensive. So they wanted to go ahead and get the orders in and on their books and have the inventory now versus potentially placing that order 3 months or 6 months from now and having to pay a large tariff to pull that order in. Does that make sense? Now, are we actually going to get new tariffs? I know tariffs was talked about during the Trump presidential election, but I don't know about you. I didn't personally feel like they came out with like this great plan of exactly what we're going to do and how we're going to do this tariff and how it's going to help the economy. It's just, there's a lot of sitting on the sideline right now with investors and a lot of pause waiting to see, you know, what is the policy going to do? What is the presidential policy going to be? What is Congress going to focus on? Um, like I said, it's just really interesting, and it's not anything that can start yet because we haven't had the inauguration yet, right? So, what the impact that we've had, what we can see, Elon Musk is somewhat involved, and they um, got some sort of spending bill that I felt like would shut down the government for a little bit, like on pause. Like I said, it's just we don't really know what's going to happen at that level, and that's, in my opinion, causing investors to really not make big decisions or lead to big movements until we have a little bit more clarity with what's going to actually happen. Um, so that is, for me, fascinatingly interesting. It'll be something interesting to watch. Fundamentally, government spending is a problem for mortgage rates. That's because when the government spends and spends more money, in case y'all didn't know, there's budget deficits, and budget deficits have to be financed with government bonds, and government bonds are a really good substitute for mortgage bonds. If investors want to invest in bonds and they want to get something that's very secure and get a fixed rate return, well, government bonds are considered less risky than mortgage bonds because at the end of the day, the US, it's assumed that they can't and will not default on their debt, right? And we all know that mortgages, while they're backed and they're pretty solid, mortgages can potentially get defaulted on. So it's more fiscal responsibility in the US government will ultimately lead to better mortgage rates. But I don't know if we're going to get a lot of that, quite frankly, when you have a Republican president and a Republican Senate and a Republican House, because they can kind of push through whatever they want. I kind of was excited to see them fighting and arguing and not getting along. Um, because maybe they just keep spending all the money. So anyway, it's really really interesting to watch it all shake out. With that said, though, I do think that in the next 3 to 6 months, depending on how this data shakes out, but I think there's a better chance for the data to shake out that things are a little bit worse than we think they are economically. But remember, a little bit worse economically should lead, I think, to better interest rates. obviously better interest rates, and we saw what a couple points does on a $350,000 house. It effectively makes real estate cheaper. Like when rates go down, every home that's on the market just got put on sale a little bit more, right? So so it'll be something fun to watch. Let me give you some resources here real quick, guys. Let's see. Thing here. So I should mention this earlier. I forgot to slide over. So one of the links, so I showed you the economic events that are coming up that you can link to and see what's going on my Linktree page. And again, I'll put this in the comments one more time. Hopefully you can save that and use it and send it to all of you and your friends and your family, anyone looking to buy a house or rent a condo at the beach or whatever. Obviously, we want to help them. But what the when they're when we're looking at the Fed and who the members are and what the data is, what their investors are trying to do is they're trying to project what will the Fed actually do. And there's a website that keeps up with all this. So it'll tell us the next Fed meeting, remember Federal Open Market Committee. Um, Next Fed meeting's 21 days, 1 hour and 11 minutes from now. And currently the Fed rate is 4.25 to 4.5. And right now, all expectations are there's a 95% chance of a Fed pause. We're going to stay at the next meeting 4.25 to 4.5. Okay. If we get a bad jobs report on Friday and unemployment goes up, you will see this number change. Now, how much depends on what the Fed says and how bad the actual data is. But this type of movement will cause investors to make different bets in their market, different bets in their portfolio. Obviously, our hope is that they want to invest in more mortgages, move more money into our bonds, and that lead to better interest rates. But this is kind of an interesting website. A lot of people don't know this is how it works. And you can even look at future Fed meetings. So the next Fed meeting is January 29th. The one after that is March 19th. Right now, we're pricing in over a 50% chance of them continuing with the pause, staying at 4.25. But there's currently about a 40% chance that they cut 25 basis points, go to 4 to 4.25, and a sliver of a chance that we get a 50 basis point cut. And you can look at these, numbers and expectations going out into the future. This is the actual probabilities that investors are making bets on with their portfolios, with not only what the Fed is going to do next meeting, but the meeting after and 6 months from now up to about a year out. Okay. Um, you can see here going out as far as December. Well, there's a 15% chance priced in that we stay the same. 30-ish% chance that we're 25 to 50 basis points lower, but there's sliver of a chance here that we're going to be 1.25 points lower right now than we are with the Fed funds rate. If they've cut rates that much, then the only way we're going to get to that is if we get some really bad jobs number and we show that the economy is in a more of a precarious position than we think it is right now. So, like I said, it's you can kind of see where investors are thinking. Again, I think these probabilities should be shifted more to the left. I think there's more chances of more Fed cuts because they're going to be responding to a um, poor economic news and poor job creations. But we'll see. We'll see. With that said, guys, certainly happy to sit around and go over any more questions you guys have. We just had one investor starting to build more. So, Jason, yeah, so what that is, the investors that are buying subdivisions or the builders that are building subdivisions that are 100% investors and they're just selling it to a hedge fund or whatever, that is the market doing what it does to meet demand for the housing that we just don't have or didn't build over the last decade that we should have been building. Um, I don't think it really impacts the mortgage market. What absolutely is happening with inflation is that when I got in the business, I've been doing this 18 years now. when I got in the business, in 2000, whatever it was, six, seven, the guy who managed the McDonald's, right, who made 45, $50,000 a year, whatever it was, managing McDonald's, he was a potential client to buy a house. That client was someone we were talking to about, well, you don't really need to rent because you're throwing money away, but you can build wealth and let's buy a house and it's the same amount of money, or maybe it's a little bit more expensive, but you're investing in yourself. But that was a potential client. In today's market, with home prices and rates where they are, the guy who manages McDonald's, he is not someone who can probably buy a house on his own, right? You have to have, he's got to be married and she needs to manage. Like you have to have two incomes, like to be able to afford a house in this market. That's not necessarily totally inflation driven. It's because we, as a society, again, in my opinion, did not build enough housing for the population that we had. And that's why you've had such a shortage. And I think it was the perfect storm with COVID where you had really low rates. So you had big demand for houses. And we kind of realized, oh crap, there's not enough houses out here. Right. And then you've had people try to build them really fast and get more houses on the ground. And that was something the economy came up with. That was capitalism being capitalism. Let's just build more houses and rent them out. It's also a problem with, quite honestly, it's a lot easier to get a permit to build a single family residence than it is to get a permit to build a uh, apartment complex because people don't want apartment complexes in their backyard. They feel like it brings in bad neighbors or whatever. The problem is it's kind of inefficient. Apartment complex, I think, can be built per square foot cheaper and house more people, and it be a rental. I don't know. I've got a lot of thoughts on that, but overall, the mortgage market is a home is becoming more of what I call, it's not necessarily a luxury good, but it's becoming more of a luxury good. Economically, luxury goods are things that have demand because people with money want to buy them, things like yachts or Rolex watches and stuff like that. Um, they don't really respond to supply and demand exactly like normal commodities do. But housing has become so expensive that you have to have a little bit more affluent customer to be able to afford a house. And what that means for us, everybody here in the real estate market, everybody in this class, is we have to focus our marketing efforts towards those individuals, right? I think it's a lot smarter right now for real estate agents to sponsor and do classes and lunch and learns or whatever at a local school where you can get in front of teachers who all have, a pretty decent salary. We could all probably agree they could make more, but have a pretty decent salary, and they're usually married to someone who also has a decent salary because teachers like being with kids and they're maternal and they have kids. And usually, if you have kids in America, you're married, and yeah, if you're a teacher, your spouse works. So I think that makes a lot more sense than paying money to litter an apartment complex with flyers about why you should own versus renting, right? Because usually the people in the apartment complex probably you have a higher likelihood of hitting a group of people who, quite honestly, don't make as much money. And marketing your efforts towards people where there's a little bit more money is more important now than it's ever been in the real estate market. Um, wow, long conversation there. But hopefully that's helpful. That's kind of my thoughts on that. Um, any other questions, guys? What we've got about 4 minutes. If you want to, you can go ahead and we never took our second break, but if you want to go ahead and do the whole thing to sign out, name, email address, phone number, license number. But do me a favor, guys, stay on the call until 1 o'clock. I've had times where someone was like in and out, and then cut out a few minutes early, and then we didn't have quite enough time in the class to be able to issue the CE credit, and I didn't want to be in that predicament ever again. Um, Let me unshare my screen so we can at least look at each other for a minute. There we go. And but guys, I'm happy to hang out and answer questions. I know I had some like direct messages, So I'm happy to go through those, or if y'all just want to call me. Um, like I said, hopefully the class you found it interesting. It's going to be interesting to watch. I think the class will be a lot more interesting a few months from now versus now because there's just so many wild cards. And the biggest one, like I said, is what is presidential kind of government policy going to be? We've elected a new president, but I don't think, like personally, I don't know, like you know, actual boots on the ground. Like, what are we doing? We're not you know, are we redoing Social Security or are we like, there's just not about the only thing I've heard is, tariffs. So anyway, it'll be interesting to see how it shakes out. Let's see. Thanks, guys. Thanks for the kind words. Really appreciate it. And we've not bad. We've only got a couple minutes here where we stare at each other. And if I would have taken the break like I should have, we would have been wrapping it up right in time. Um, Thanks, Tyler. Appreciate it, bud. Hopefully we can get the Skinner's house sold. If you want to do a shameless plug for their house and got some agents here with buyers that want to go sell it, we'd appreciate it. We've got a client that's got a contingency. We need their house to go under contract to close a loan for them. Thanks, James. I appreciate it. So, Susan, you being in this class, you'll be on Dana Sparks' email list now. Obviously, I'll have your stuff. I'm getting better at this. One of my New Year's resolutions is to be better with these classes and get the information out. But my intention is to get emails out as I have CE classes coming up. I always teach at this time every month. So I always teach the first Wednesday of the month. Now, the class and the subject matters will change and I'm not exactly sure what I even have on the docket for next month, but I rotate between this class, my short-term rental investing class. We've got some basic mortgage, like Mortgage 101 and like FHA, just some more of the nuts and bolts of the business and things that I think real estate agents can know or need to know to be successful. So we rotate through about 4 or 5 classes. So I'll end up teaching all of them twice, sometimes 3 times a year. Um, but yeah, I'm always on Zoom. Unless I have a previous conflict and we've changed it, I'm always on Zoom the first Wednesday of the month. Oh, or I guess not first, second Wednesday of the month. Excuse me, second Wednesday of the month. Yeah, we do the short-term rental. Jennifer, we do that short-term rental class virtually. So just again, look out for your email and I'll try to get information out to everybody in the class and we'll go that. Guys, my phone number, you can call the office 678-552-1513. You can also go to that link tree link that I sent you and download my contact information. But it's 678-552-1513. Is how to get a hold of me and my team. Thanks, Deborah. I really appreciate it. Thank you, Mauricio. Posted. Yeah, let me get that link tree. So the link tree's back in. Oh, it was a direct message. Everyone, there we go. There's the link tree. Here, I'll post it a few times so it shows up in the feed. How about that? But yeah, you can get my contact information there. Give me a call anytime. We're a minute after one, guys. If you're done, no questions, you're welcome to sign out. Appreciate you hanging out with me today. Hopefully it was helpful. And obviously, any customer, client, anyone looking to purchase, refinance, just have mortgage questions, would love to speak with them anytime, every time, all the time. So appreciate it. And I'll hang out for a few minutes if there are questions. Otherwise, we'll end the class here in a little bit. See you, Courtney. Thank you very much. I appreciate it. Thank you. Thank you, everybody. I appreciate it. Really appreciate the kind words. Hi, guys. There's no other questions. I'm gonna go ahead and end the meeting. Hope you had a good time here and look forward to working with you in the future. All right.